obviously revise, refresh the basics. Then we go into the deep dive of the subject. So the very basic aspect, as far as individuals are concerned, we have studied it long back. The residential status, right? And why this needs importance today is because of the change which has taken place recently, not recently, but yes, not too far away either. So the idea here is to cover the aspects of not ordinary resident, which is the recent, while the concept was there since ages, but now it has catched up a lot of importance because of the recent changes and amendments. Right. So as far as the residential status is concerned, we have it into two baskets, the two main baskets, that is resident and not ordinary resident. Right. Within resident, we have ROR, that is resident, ordinarily resident, and resident but not ordinary resident. So what was the condition earlier and what changes is what we are going to focus right now. So the basic condition, we all know, 182 days or more, right? If I don't satisfy this condition, I go back to the second condition, that is 60 days or more in a financial year plus 365 days or more in the preceding 4 years relevant to the relevant financial year or the relevant previous year, right? Okay. So there is an exception. If you can see the star mark there, 60 days, that is where the real game is. So 60 days were initially replaced by 182 days. 60 days were initially replaced by 182 days in case of person leaving India, person who is an Indian citizen who leaves India for the purpose of employment. So for example, if I hold an Indian passport and I am going out of India for the purpose of employment, then this 60 days gets replaced to 182 days, right? Second exception is again 60 days gets replaced by 182 days in case of person of Indian origin or again an Indian citizen who comes to India for a visit. Who comes to India for a visit. Basically, I am a person of Indian origin. Now, what do you mean by person of Indian origin? A person whose grandparents were born in undivided India. Not just I myself, who were born in undivided India. That person is called to be a PIO, that is person of Indian origin. So if I am a person of Indian origin, I am staying outside. If I come to India on visits, even in that case, earlier the condition or the criteria was 182 days or more, right? So this is where the real catch was, that people used to plan their residential status in such a way that they are non-resident. They are in India for 179 days, 180 days, 182 days, right? So 179 days, 180 days, 175 days, exactly on the borderline. I stay out of India for more than 182 days and therefore I am a non-resident. I earn income because see, what is the change? If I am a resident, then I need to pay tax on the global income, right? Is everybody aware of this? This is the basic. If I am an Indian resident, as far as income tax is concerned, I pay tax on the global income. However, if I am an Indian resident, I pay tax only on the Indian source income. That is where the real change or the real game is. So therefore, if you see, 60 days gets replaced by 182 days. So therefore, government realized that there is a catch here. People are misusing this provision to overcome their residential status and therefore not pay tax in India. So, and again, the additional conditions for being a resident is again, you have to be resident for 2 out of 10 years and present in India for 730 days or more during the 7 preceding financial years. This is where the additional condition comes into picture, right? So, what is the change? The change is Finance Act 2020. While I say it is recent, it is not that recent either because we are in 2025 already, but still, this is not that old either. So we need to relook at this. For citizens of India or person of Indian origin who being outside India come to India on visits, Residency triggers with the reduced period of 120 days. So 182 days is now being reduced to 120 days. Right? If the total income other than foreign source income is more than 15 lakhs. If the total income other than foreign source income is more than, so twin condition, one, I should be coming to India on a visit, of course, and my stay in India should be 120 days or more. Second condition is my Indian sourced income. Total income other than foreign source income means Indian source income. My Indian source income should be more than 15 lakhs. More than 15 lakhs. So effectively, if you see, the target is not the small taxpayers or the small earners. It is purely the people who are earning more than 15 lakhs from India. Right? Then second exception is again citizen of India not liable to tax in any other country by reason of his residency, domicile, or similar criteria. He is also deemed to be resident in India. Now, again, as I said, all these HNIs or high net worth individuals, they used to plan their residential status in such a way that they are non-resident of all the countries where they have been. Right? If they are aware that what is the number of days criteria in US, okay, this is the number of days, I'll be less than particular days in US. UK, again. So you and me can't do this. Yes or no? Can we do this? Therefore, the criteria of 15 lakhs. Right? So the idea here is to catch hold of people who plan their residential status in such a way that they don't pay tax in any of the countries. Right? Citizens of India not liable to tax in any other country by reason of his residency, domicile, or similar criteria, deemed to be resident. Again, this is specific to Indian citizens, Indian passport holders. Subsequent qualification CVDT specifically said that specifically for people who are working in Dubai, UAE, etc. Now, as far as Dubai, UAE is concerned, you know, there is no tax. There was no tax rather in 2020. Now, slowly and steadily, income tax is also coming there. Right? So, specific circular was brought in or press release was brought in to carve out an exception or to clarify that as far as non-resident is concerned, individuals who are genuinely working in UAE or the Middle East, right? For them, basically, there is no intention to tax those people because they are genuinely working their residential status. So, therefore, this will not be considered as any, I would say, restriction in their case or any taxability in their hands. It will not get triggered. Foreign income will be taxable in India only if such income is derived from a business or profession in India. This is the clarification which the CBDT gave. So now, this is the change if you see. Pre-budget, post-budget, and post-enactment. Earlier, which was 182, now it gets reduced to 120. Right? So 182 gets replaced by 120. Another condition is your Indian source income should be more than 15 lakhs. More than or equal to 15 lakhs. So I will be resident. I will be not ordinary resident. If my Indian source income is 15 lakhs or more, and I have spent in India 120 days or more. Okay. Assuming I have spent 140 days in India. Take a scenario. I have spent 140 days in India and my foreign source income is 14,99,999. Will I be NOR or will I be NR? Non-resident or not ordinary resident? Non-resident. Is everybody with me? Right? Simple. So therefore 15 लाख का भी लिमिट जो है हमको ध्यान रखना है that my income from Indian source should be 15 lakhs or more. Okay. Last but not the least, Indian citizens not liable to tax in any of the countries. Again, in this case also, if their income is more than 15 lakhs, they will also be deemed to be not ordinarily resident. Again, in this case also, they will be deemed to be not ordinary resident. Am I clear? We are relearning the basics. Yes, is everybody with me? Let us check. So this is the summary of slide, right? So let us check if really everybody is with me or not. We'll have a look at few case studies. Okay. So Mr. A, who is a business head for Asia Pacific region of a multinational company, he has to travel to various locations for business purpose. He has spent 200 days traveling in 22-23 or 23-24, whatever it is. Relevant year, if you can say. Also, he has been traveling abroad for past 2 years and stayed out of India for 400 days in this period. Now tell me whether Mr. A is a resident, non-resident, not ordinary resident. What exactly is his residential status? Yes? Chalo, let us go step by step. What is the first condition? 182 days or more in India. Is he in India for 182 days or more? 200 days out of India. साल में होते हैं 365 days. Leap year होगा तो भी 366 days. So 160 days net approximately is in India. So first condition not satisfied. Second condition, 60 days or more. Is it satisfied? He is in India for 60 days or more and 365 days or more during the 4 preceding years. So that also is satisfied. Yes or no? So basic condition not satisfied. Basic condition 2, 60 days or more satisfied, 365 days or more in the preceding 4 years satisfied, right? Additional condition, again, 2 out of 10 immediately preceding years. So apart from this, he is in India only. Apart from this, he is in India only. So therefore, 2 out of 10 being satisfied, 730 or more immediately preceding 7 years also satisfied. So therefore, is he a resident? He is resident, right? Additional condition being satisfied. Let us look at case study 2. Miss Poo went to London to join a reputed university for a graduation course, which is for 3 years. While studying there, her professor suggested her to join a postgraduate course at the same university. वो हो गया 2 साल. Then she had to get an internship certificate to complete the course. Upon completion, the firm offered her a permanent position. She has now been employed there for past 4 years. Past 4 years. Miss Poo has stayed out of India for 9 years now. 9 साल हो गया, she is out of India only. She receives rental income from property that she has inherited from her parents. Now, 9 years outside India, it means 182 days तो गया ही काम से, right? So prima facie looks like a non-resident. Yes or no? Let us look at it. Basic condition, resident in India for minimum 182 days. She has not come to India, so not satisfied. 182 days or more in the current financial year, not satisfied. 365 days or more, again not satisfied, right? Again here 60 days will be replaced by 182 days because she is out of India for the purpose of employment. Because she is out of India for the purpose of employment. Next case study. Miss B, a PIO, person of Indian origin, residing in Canada and doing job there, visits India regularly to meet her parents. She visits India to meet her parents. During the financial year, say 22-23 or whatever, she is in India for more than 120 days, 135 days. She earns dividend income. During the year, she has earned 16.50 lakhs, which is more than 15 lakhs, right? This is the amendment we are talking about. So now what will be the residential status of Miss B? Yes? RNOR, right? Resident, but not ordinary resident. So 120 days satisfied, 15 lakhs satisfied. So therefore, since she is a PIO, as per the amendment, be a resident, but not, right? Is everybody with me? Now, why this amendment is important, or why really does it make any sense, right? So this is again, I'll not go on the basics of scope of total income, etc. I'll just go to this slide, which summarizes the entire scope of total income. That is section 5. ROR, as you all know, resident, ordinary resident, global income is taxable. Now, if I earn any income from US, if I earn any income from whether I am going there or whether I am sitting here, entire income will be taxable in India. However, in case of not ordinary resident, only the income source from India is taxable. Income received or deemed to be received, section 9, which we'll see in the subsequent slides, right? Which is income deemed to accrue or arise in India, that also is taxable in India. Income derived from business or profession control or setup in India, as the case may be, right? Now come to non-resident. Income source from India, that is same as NOR. Income received or deemed to be received in India, again same as NOR. What is removed from NR is income derived from business controlled or profession setup in India, right? That is the difference between NR and NOR. What is the difference? If I am earning anything from business setup or control from India, NOR होगा तो उसके हाथ में वो taxable होगा, right? However, non-resident होगा तो उसके हाथ में वो taxable नहीं होगा. That is the limited difference between, right? आगे बढ़े? Yeah. So see, yeah. So when you say income, it is, so as of now, there is no clarification on the same, but the way I understand, income means any income. Income means any income. While I can argue that this should be only my income and not the clubbed income, because clubbing is a deemed income. That is not my real income. While technically I can argue, but this is an untested territory, right? While I can argue that this should be only my income, which is 15 lakhs and not the clubbed income, but intention doesn't seem to be so. Yes. Yeah. But the intention of the government seems it is taxable income, or the income, it will be clubbed also. Better don't raise this query, otherwise amendment will come. Right? Now coming to income deemed to accrue or arise in India, that is section 9. This is a deemed provision. Okay. What are the income which are taxable? This is taxable in both hands, that is NR as well as NOR. Resident के हाथ में तो वैसे भी सब कुछ taxable है. तो very first basket is 911, that is business connection, property, asset, source of income, which is in India, right? Then comes salary 912. Salary के बाद again 913 is salary paid to government employees, right? Paid by the government. 914 is dividend. 915 is interest. 6 and 7 very important, royalty and fees for technical services. 6 and 7 is very, very important, royalty and fees for taxable services, fees for technical services. All these incomes, if you see 912 to 917, this will be taxable in India if they are attributed. Effectively, if the source is in India, if the payer is in India, then irrespective of where the receiver is, this will be taxable. Because this is deemed income, right? Deemed to accrue or arise in India. So all these income, if they are Indian based income, these will be taxable. So let us look at one by one. Business connection. All income accruing or arising directly or indirectly through or from business connection, property, asset, source of income, transfer of capital asset. Simple example can be, I am an NRI, I'm in USA. I have a property here. I am earning rental income. Will it be taxable? I am receiving the rent in my US bank account. Will it be taxable? I will say I have not received it in India. It will still be taxable because the source is in India, the property is in India. Asset in India. If I am earning any income from an asset in India, even in that case, it will be considered to be deemed to accrue or arise in India and transfer. Right? Business connection. Now, what do you mean by business connection? Have you heard about that earlier? Yes, no? Okay. Any asset. Any asset. Yeah. 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 So, first of all, goodwill is an intangible asset. Who owns that goodwill? I own that goodwill, right? So, as far as goodwill is something for which nobody will pay you as such, purely for goodwill. It will be anything, the rights in relation to goodwill, or it might be non-compete, right? So, all these cases, technically speaking, you will have to see, irrespective of whether the asset is tangible or intangible. If the payer is in India, if that asset is being utilized in India, then it will be deemed to accrue or arise in India. Okay. Now, one important thing is it is clarified that the expression through, यहाँ पे if you see, all income accruing or arising directly or indirectly through shall mean and include shall be deemed to always meant and include by way of in consequence or by reason of. That's okay. So, why it was clarified, I'll come to it later on when we discuss the other aspects. Now, business connection, right? Let us quickly go through business connection. Have you heard about the term permanent establishment? Right? Permanent establishment is something which is defined in section 92F, if I am not, and it is an inclusive definition. The definition simply says it includes. 92F only says it includes. However, it does not say what types of permanent establishments are included as far as the act is concerned. For that, you need to go back to the respective tax treaty. However, if you look at section 911, this I would say is Indian equivalent permanent establishment, business connection, wherein it has a very wide scope as compared to a tax treaty, right? If you see the basic concept of non-resident, right? Real and significance or substantial economic nexus. If you look at the concept, business connection means I should have a business related connection in India, either an agent or my employee, any person who is working for me. In a nutshell, if I have to tell you in a layman's language, any person who is working for me in India as my agent, he or that company or that entity will create a business connection for me. What are the essential features? Real and intimate relation. It has to be real and an ongoing relation. Should be one of the continuous relation, right? Relation contributes directly or indirectly to the earning of income by the non-resident in the business. A course of dealing and continuity of relationship and not mere isolated or stray nexus. So it has to be a continuous relationship. If you look at the definition, it includes, again, this also is an inclusive definition, business activity carried out through a person who habitually exercises in India authority to conclude contract on behalf of non-resident or habitually plays the principal role in leading to conclusion of the contract by that non-resident, and the contracts are in the name of non-resident for the transfer of ownership or for granting or for use of property owned by that non-resident, or that non-resident has the right to use the property for the provision of service by the non-resident. So very first example is basically authority to conclude contract. If I am an agent, I have an authority to conclude contract on behalf of my principal who is outside India. Then it is a clear case of business connection. Now, Indians are very much sharp in interpreting the law. क्या लिखा है? Authority to conclude contract. I will not sign the. Everything will be done by me. Negotiation will be done by me. Price will be fixed by me. But it is just that the contract will be signed by the non-resident. That is how people used to plan this. Later on, now when BEPS came in, base erosion profit shifting, MLI came in, to align with those international principles, the second leg is now being brought in. That is habitually plays principal role leading to the conclusion of contract, and that contract is in the name of non-resident, right? So basically, even if the contract is signed by non-resident now, after this amendment, even if the contract is in the name of non-resident, if an Indian person plays a vital role or a principal role in conclusion of the contract by non-resident, even then it will be considered to be having a business connection in India. Business connection in India. Okay. Second is maintains in India stock of goods for which he regularly delivers the goods on behalf of the non-resident, or secures orders in India mainly or wholly for the non-resident, other non-residents subject to common controls as the former non-resident, right? So basically, either I am concluding the contract, even if I am not signing it, even then I will be considered to have a business connection. Second is I maintain stock in India on behalf of non-resident and I deliver the goods. Third is securing order. If I am a sole selling agent of that non-resident, mainly or wholly for that non-resident. If I am independent agent, it means I am acquiring orders from various multinationals, various companies, then I don't fall here. Because it says secures orders in India mainly or wholly for the non-resident, for that specific non-resident or that group per se. Okay. Subject to common control as the former non-resident. Now, what is the exclusion? Limited purpose. If you see the exclusion, which was there earlier, activities limited to purchase of goods. Activities limited to purchase of goods for non-resident. This was an exclusion earlier, which said that if you are just purchasing the goods on behalf of non-resident, not doing anything else, then this will not constitute your business connection. This was an exception or exclusion, which was there earlier, which is now being deleted. So now even if you purchase the goods, then also business connection arises. So business connection does not include any business activity carried out by a person having an independent status. Now, as I said, if you are acquiring or doing business for multiple businesses or multiple non-residents, then in that case, you are not considered to be dependent. You are independent. So as I said, if you are independent, you are not covered in the definition of business connection. Now, when business connections becomes very, very critical is where you are working for the corporates with whom we don't have tax treaties. Because if we don't have tax treaty, I fall back on the act. When I fall back on the act, 911 can get triggered. Because if I look at the treaty, I have to go to the permanent establishment and override. Treaty will override the act because the definition of treaty is narrower. I can overcome the definition of business connection. But for the cases where I don't have treaties, business connection becomes very, very important or critical, right? So what are the key attributes in case of business for which all operations are not carried out in India? Assuming only few operations are carried out in India, other operations are carried out outside India. There you will have to do allocation of income. That to the extent the activities are done in India, the proportionate income will be taxable in India. The balance income will not be taxable in India. So it is attribution of income restricted to the Indian source. The idea is to tax only the Indian source income, right? Exceptions: no income shall be deemed to accrue or arise in India. In case of NRIs or non-resident rather, business of which operations are confined to purchase of goods, this was there earlier. Now this is being removed. Non-resident running a news agency. Non-resident running a news agency who is just collecting news. This is still in the exception. And again, for shooting cinematographic film in India, again, this is still in exception. Last but not the least, foreign company engaged in mining activities are confined to display of cut or unspotted diamonds. This again is an exception, but apart from these, there is apart from these, there are no other exceptions. So if you don't have a tax treaty in India, you need to be mindful of business connection. Any questions? Let us look at an example. Mr. X and SSC carried on a business as an importer and as a commission agent of non-resident exporters. For two of the non-resident exporters, he canvassed orders for supply of woolen yarn and communicated the same to the non-residents and received commission. Mr. X had no authority to accept any order on behalf of the non-resident. Non-resident was not obliged to accept the order procured by Mr. X. Orders were accepted, price received, and delivery of goods was everything done by non-resident. Case whether you have a business connection, yes or no? No authority to conclude contract, right? Everything is done by the non-resident. Therefore, do I have a business connection? Yes or no? Yes or no? No, right? No business connection. Next case study, ABC of Netherlands used to import iron and manganese ore from India. Being dissatisfied with the activities of the Indian exporters from whom they purchased, they appoint Mr. A as its representative in India. Mr. A was to supervise the correct execution of the contract of ABC with the Indian exporters as to quantity, quality, time of delivery, transport, etc. A's activity involved procurement of raw materials and ensuring regular supply of raw materials. A is to get remunerated from ABC. In this case, whether there is a business connection? Yes. It constitutes a business connection, right? Blue Star Engineering. This is where the indirect transfer, I'll just quickly touch upon this further. Now, a case where, you transfer the shares. You remember Vodafone? Supreme Court ruling? You remember Vodafone acquired the business from Hutch? The shares were transferred outside India. The shares were transferred by a non-resident to another non-resident. The company of which the shares were being transferred also was outside India. Yes or no? So therefore, there the Indian government tried to say that your valuation in India is substantial. You have a subsidiary in India. So therefore, you have to pay tax in India. However, Vodafone or Hutch at that point in time said that basically we don't have any presence in India per se. The company which is selling the shares and the company which is buying the shares, they are nowhere, anywhere in India. No presence in India, no physical presence in India. We are outside India. जिसका shares बेच रहे वो shares भी India के बाहर है. Then how come you tax that income in India? This is extraterritorial jurisdiction. You don't have jurisdiction to tax me. Right? Matter went up to the Supreme Court. Supreme Court read through the law. And Supreme Court also confirmed that yes, this should not be taxable in India. And as it happens in India, after every Supreme Court ruling, there is a retrospective amendment, right? So what is that retrospective amendment? Now they say that if you have shares in any company or any partnership firm or whatever in India, value of the Indian company is more than 10 crores. छोटा मोटा transaction नहीं चाहिए हमको, बड़ा बड़ा transaction चाहिए. If the value of Indian company, in this case, if you see, transfer outside India, the SPV of which the shares are being transferred also is outside India. सब कुछ बाहर है. फिर भी, if you have an Indian subsidiary, ICO, which has the value of 10 crores or more than 10 crores, and the value of shares of ICO is more than 50%. Substantial means more than 50% of the value of assets of the SPV as on specified date. So on the date of transaction, if the SPV, suppose the value of SPV is 100 crores. If the value of SPV is 100 crores and the value of ICO is say 40 crores, then this explanation will not trigger. However, if value of ICO is say 51 crores, it means the value of ICO is more than 10 crores and value of shares of ICO is more than 50%. 100 crores में से 51 crores India है. So therefore, to the extent of that 51 crores, this will be subject to capital gain tax in India. Again, this is explanation 6 to section 911, substantial value in case of And here also the treaty will play an important role. Treaty will play a very, very important role because this amendment is in the act itself. It cannot override the tax treaty. So wherever I have a tax treaty, I can still go for the treaty protection and say, again, looking at the wordings of the treaty, etc., that this transaction should not be taxable in India, while you have indirect transfer taxable in India. As far as the treaty is concerned, treaty covers only direct transfers, not indirect transfers, right? Yeah, you have to consider both together. If both the SPVs are in India, 40% each. Yeah, then it is an independent. Again, there is another concept called GAR. There is another concept called GAR. So you have to consider that also, right? Yeah, yeah. So it is the market value. There is a specific formula which is given, that is 11 UA valuation, if you remember. The same valuation rules apply here, right? Very interesting concept, but it has already been triggered in 2-3 cases. India has already exercised its rights in 911. Yeah, yeah. But there, yes, there again you have exceptions under section 47 where uh, shares are treated as tax neutral. So if you satisfy those conditions, then it will not be taxable. Yes, outside India. Yes, you have to satisfy 47 for that to overcome the taxability in India. Yeah, date of transfer. Yes, right. So here, if you see the date, this is where the date comes into picture. Balance sheet date prior to the date of transfer, or the date of transfer if book value on the date of transfer is more than the book value on the balance sheet date by 15%. So if suppose my balance sheet date is 31st of March and I'm taking this transaction in say April, May, I have to prepare balance sheet both as of 31st March, which will already be there. Plus, I have to see the balance sheet as on the date or book value of the asset as on the date of transfer. If the variation is less than 15%, then I can go by the last year balance sheet. I need not prepare a separate balance. If the valuation has been different, or the gap in valuation is more than 15%, then I will not be able to consider the last balance sheet. I will have to rework the entire balance sheet as on the date of transaction, as on the date of transfer. Yes. Yeah. Yeah. Yes. So book value, when I say again 11 UA valuation, because if you have immovable property, etc., then you need to consider the stamp duty value if it is less, if it is more than the book value. Now you will say, ठीक है, इंडियन गवर्नमेंट को पता कैसे चलेगा, ये तो ट्रांजेक्शन बाहर हो गया. How will the Indian government come to know that this transaction has taken place? जब तक आई को कुछ बोलेगा नहीं, जब तक आई को अपने बैलेंस शीट में कुछ डिस्क्लोज करेगा नहीं, उनको पता चलेगा क्या? Because for ICO, SPV still remains as my holding company. SPV still remains my holding company. I will not report anything. How the government will come to know, right? So therefore, smartly what they have done, they have put the reporting obligation on India. They have put the reporting obligation on ICO. वो तो इंडिया में है. तो आईको को बोला है कि if such transactions happen, you have to report under section 285A. If you don't report, then there is a simple penalty of 2% of the transaction value. Forget about the capital gains. 2% of the transaction value, right, is what is the penalty which is there for ICO. So how will the government come to know? ICO is being mandated to do the reporting. If ICO does not do the reporting, capital gain calculation नहीं होगा. जो भी डील वैल्यू है उसका 2% सीधा सीधा पेनल्टी लग जाएगा किसको? इंडिया को. As simple as that. It's a group. It's a group, right? See this. Yeah. Yes. Yes. So therefore, that is what I am saying. These transactions generally happen when it is a group structure. If any changes happen overseas, now it is ICO's obligation or responsibility also to educate their parent companies or the group companies that this is the policy in India. If any changes happen overseas, please let us know. Otherwise, there will be a 2% penalty. So therefore, it is ICO's responsibility also to inform its parent or group that wherever any changes happen, which has the material impact on India, please inform us. We need to report it to India. We need to report it to Indian tax authorities. So we cannot say that I was not aware what happens overseas. I was not aware what happens with my parent company. I cannot take that shelter and say that how will I come to know? It is very clear that now this is my obligation to report. So earlier, even if I was not supposed to know, now there have been, you know, India is changing big time. Earlier, whenever you go back to your parent company and ask for any details, they will say it is confidential, we cannot share. Now, the Indian law is such that you just need to show this 2% penalty. They will, samne se they will inform you. As simple as that. Right? So the law is very stringent now. So even the non-resident is aware of the Indian laws nowadays. Okay. Yeah. Yeah. Market cap. Yeah. Okay. So there are a few exceptions. There are few exceptions where there is no change in the management or control and the voting power or share capital or interest is less than 5%. Again, another exception is no income deemed to accrue or arise in India if the transferor at any time during the 12 months period holds no management or control in SPV1. Again, a multi-layer structure, SPV1, SPV2 and ICO, right? No right in SPV1 that entitles him to management to the management and control. And last but not the least, again, less than 5% interest. So basically, if the interest is less than 5%, if the interest is less than 5%, kiska interest? Transferor ka interest, then these two exceptions will apply. Otherwise, 911 will get triggered, again subject to treaty protection. Again, subject to treaty protection. Okay, now this is where I come to the treaties. Availing tax treaty benefits, section 90. Now you all are aware about tax treaties. DTAAs, right? India has 95. Okay. So what is the purpose of these tax treaties? We can quickly go through. The idea is to avoid double taxation. Idea is to avoid double taxation and to give tax credits wherever necessary, if at all there is a double taxation. Right? Then to avail the tax treaty, what is the key document? First of all, who can avail a tax treaty? Can a resident avail the tax treaty benefit? Yes, I am an Indian resident. Tax treaty decide the taxability between two countries. Can a resident claim the tax treaty benefit? Yes or no? Yes. Are you sure? Are you sure? How? Will it really matter or will it really help me? Huh. Then in that case, I need to go for the tiebreaker, which is as per Article 4. of the tax treaty. That is for the limited purpose of determining the residential status. I go to the tiebreaker rule. So effectively, the point which ma'am is raising is, if I am a resident of both the countries, if I am a resident of both the countries, then I cannot be technically resident of two countries. I will have to either be resident of A or country B. How do I determine that? I will determine that by going to the Article 4, which is a tiebreaker rule, where there are four different criteria given that if I need to check where I have a permanent home, where is my family, where is my source of income, where is my economic relations, economic connections, etc. So all these are the step by step, I would say, measures which are there to provide the tiebreaker rule, where at the end of that analysis, I will be concluding that either I am a resident of country A or I am a resident of country B. Technically speaking, Section 90 is for giving you the treaty benefit, and largely it is applicable for non-residents only. Largely it is applicable for non-residents only. Right? One important aspect is majority of the tax treaties have been amended now by what? Multilateral instrument 2020. So many treaties have been amended by virtue of multilateral instruments, because to overcome the treaty shopping, to overcome, or rather to bring in place the amendments which are suggested by BEPS. The one amendment which we just saw in the act also, right, in 911, that while I don't have authority to conclude contract, I don't conclude the contract, but I play a vital role. I play a vital role, right? That is also coming through the MLI. That also is coming through the multilateral instruments. So basically, the idea of multilateral instrument was to overcome the situation where people were doing treaty shopping. Treaty shopping, as in they were setting up entities in certain jurisdictions. They were setting up entities in certain jurisdictions where there is no tax or low tax, without any physical presence or any hardcore presence there, just setting up an entity there, shell company or a conduit company, and thereby doing billing from that particular entity. As simple as that. No operations, only billing was done from that to overcome the tax liability. To overcome such situations, we have this BEPS, which is base erosion profit shifting, which is the OECD countries have brought in this change or amendment. Subsequent amendment has also been done in MLI. So what is the key document to claim the tax treaty? It is TRC, that is tax residency certificate. You need to provide a proof or a document which is the TRC issued by the respective tax authorities of that particular country. Along with that, you need to provide Form 10F. Provide Form 10F. What is 10F? It is a specific format of the Indian government wherein you need to give the details of your status, that is your individual company, etc. Your PAN number, if you have in India, nationality, tax identification number in that particular period of validity of TRC, and your address in the respective country. So along with the TRC, because the TRC of each country will vary, हर एक का अपना अपना फॉर्मेट होगा. कोई कंट्री एक लाइन में लिख के देगा दैट यस रेसिडेंट ऑफ दिस कंट्री, कोई कंपनी कोई कंट्री डिटेल में देगा. So to overcome such mismatches, they have provided a specific requirement in Form 10F. Along with your TRC, you have to submit Form 10F now, which is online. Earlier it was physical. Now 10F has also to be submitted online. Right? Every year. So wherever you have income in India, so effectively whenever you are claiming treaty benefit, you need to file this every year. Yeah. हाँ नहीं मिलता है. Yeah. Nowadays, Dubai is also giving TRC, provided you have spent 6 months in that particular country, you have a proper employment, etc., etc. So that also is being provided, because now this was an issue earlier where Dubai was not providing, but now with income tax also coming in, this problem will also be solved. But yes, if you are a resident of Dubai, even then the Dubai tax authorities are giving you the TRC practically nowadays. Correct. Correct. Yeah. Yeah. So there, in that case, see, practically speaking, we'll come to the dividend taxation, right? In that case, we'll come to whether you are actually correct. Ha. Correct. Correct. I'll come to the interest and dividend taxation later. Yeah. Right. So I think Gautam has already covered taxability of capital gains yesterday. Yeah. Yes. Hmm. No. Then you are a resident of India or non or USA. Yeah. Then you will have to file TRs. If you are going by, so effectively you are saying I am a resident of India as well as I am a resident of UK. By virtue of tiebreaker, I conclude that I am a resident of UK. So now I become a resident of UK. Whether in that case I will have to file TRC, the answer is yes. Yes. 10F also. 10F is a self declaration. That is just a self declaration. Now, yes, capital gains, I'll not spend much time. Only quick amendments or changes which we'll just discuss. Earlier, there were three, I would say, timelines for long term, short term. 12 months and 12 months was for equity and the listed securities. For property, immovable property, it was 24 months, and for other assets, it was 36 months. Now, it is only two, 12 and 24, 36 ko uda diya, right? Either listed equities, listed shares, it is 12 months. Immovable property or any other asset, it is 24 months. Now 36 months wala bracket ud gaya post the 2024 amendment, right? So these slides will be circulated to you, don't worry. Then as far as taxability is concerned, again, it has already been covered. The key major difference, which is the long term capital gain, which was there, which was 10%, rather 20% earlier. Now that has been reduced to 12.5%. Good news. But the bad news is indexation is no longer available, right? Indexation is no longer available. The tax rate is being reduced to 12.5%. There was huge representation and hue and cry being provided specifically for immovable property because जो indexation है वो काम आता है immovable property में because the properties are held for a longer period of time, right? So now the exception is still being provided only for residential property, only for immovable property, that you can claim 20% with indexation benefit and 12.5% without indexation benefit. You have a choice to go either of the debt, either of the options. But for equity and all, now there is no option of indexation, even for unlisted securities. Indexation has been completely done away with. फिर 111A जहां पे 15% हुआ करता था, अब वो 15% को बढ़ा के कर दिया है 20%. शॉर्ट टर्म कैपिटल सिक्योरिटीज 15% has been increased 20% now, right? I think there is an error here. 15% is to be changed to 20%. I missed that. So technically speaking, these are the two key changes by Finance Act 2024. Yes, only for residential property. Not, yeah, yeah, right. Now coming to, yeah, very good question. I think let the audience answer it. Ha, ha, hmm. So what is the view? Let us take public poll. 20, 15, 1% वाला कोई है? 1%? वो भी कैटेगरी है इंडिया में? नहीं नहीं, 1% वाला भी कैटेगरी है इंडिया में. पब्लिक नॉन रेसिडेंट के केस में भी 1% डिडक्ट करता है. 194 आई है, सीए ने बोला है, ब्लेम आता है सीए पे, right? So specifically as far as non-resident is concerned, tax rate will depend on what TDS will be equal to your tax rate. What is the tax rate? What is the tax rate? If it is a short term, 20%. If it is long term, and if you are claiming treaty benefit or rather indexation benefit, then the tax rate is 20%. Now, as far as the deduct is concerned, what do I do? What do I do? सबसे पहले तो मुझे डिडक्ट किस पे करना है? कैपिटल गेन पे करना है या सेल कंसिडरेशन पे करना है? सेल कंसिडरेशन पे करना है, राइट? इसमें कुछ सीए लोग, वो दूसरा वाला सीए वो बोलता है अरे ऐसा कैसा, तुमको रिफंड क्लेम करना है, बोलने वाला भी सीए है। नहीं नहीं, इंडेक्सेशन अभी तो नहीं है, मैं पहले की बात कर रहा हूँ। ये दो सीए की आपस की जो मारामारी होती थी ना, एक अपने क्लाइंट को बचाने जाता है ज्ञान देके, वो दूसरा बेचारा ऑब्लिगेशन में आके बोलता है यार अभी मैं क्या करूं। सिंपल थिंग इज यू हैव टू डिडक्ट ऑन द ग्रॉस वैल्यू। इफ द seller or if the seller says that you have to deduct on capital gains, simply उसको जाके बोलो टैक्स ऑफिसर के पास जाओ, 197 लेके आओ, जो अमाउंट बोलेगा उतना में टीडीएस काट लेगा। अदरवाइज आई एम वेरी क्लियर, 12.5% ग्रॉस। ठीक है, कोई सीए सर्टिफिकेट नहीं चलेगा, कुछ नहीं चलेगा। आइडियल वे टू गिव TDS credit or to do TDS on net amount is to get a certificate from the officer, 197. No other route. कोई सीए सर्टिफिकेट नहीं, कोई अपना दिमाग नहीं, कोई कंप्यूटेशन नहीं चलेगा, एज सिंपल एज दैट, इफ आई हैव टू गो एज पर द लॉ, राइट? तो 12.5% इज द टैक्स रेट नाउ, वेरी क्लियर। अभी तो क्लियर हो गया, अभी कोई टेंशन ही नहीं है। शॉर्ट टर्म में 20 ना, प्लस सरचार्ज सेस, दैट गोज विदाउट सेइंग। हाँ, so now quickly we move on to royalty, fees for technical services, and other interest, dividend, etc. on for specifically for non-residents. Okay. So what do you mean by royalty? Consideration for intangibles, as simple as that. Consideration for intangibles is called as royalty for use of intangibles, right? Transfer of all or any rights, including patent, invention, model, design, secret formula, or process or trademark. Copyright, literally artistic, scientific work, including films, videotapes for use of TV or radio broadcasting. दूसरा, imparting any information concerning working of or use of IP. IP is intellectual property. Technical, industrial, commercial, scientific knowledge or experience or skill. Use of any IP or right to use any industrial, commercial or scientific equipment. दूसरा, rendering any service in connection to the above. So when I am paying royalty, royalty is generally for right to use of certain asset, be tangible or intangible. Right to use of any asset is called as royalty, right? Retrospective amendment देखो again from 1st June 1976 explanation. यूज और राइट टू यूज ऑफ कंप्यूटर सॉफ्टवेयर। अभी कंप्यूटर सॉफ्टवेयर पे बहुत सारा केसेस था, सुप्रीम कोर्ट जजमेंट भी है आफ्टर दिस अमेंडमेंट। इवन आफ्टर दिस अमेंडमेंट there is a Supreme Court in judgment which specifically says that as computer software is concerned, as far as computer software is concerned, if it is ready to use or off the shelf software, it is not taxed. It is not. अभी अमेंडमेंट क्या बोलता है? दे वांटेड टू टैक्स ऑल द कंप्यूटर सॉफ्टवेयर इररिस्पेक्टिव ऑफ वेदर इट इज ऑफ द शेल्फ और सेकंड, टेस्ट of possession, control, use, location of right, property or information not relevant. Now this is relevant for the television and the broadcasting industry, right? अभी आईपीएल चल रहा था, फिर वर्ल्ड कप बीच में भी होता है, उसका ब्रॉडकास्टिंग राइट्स किसके पास है? समझो स्टार के पास है। क्या होता है वहां पे? सिंगापुर से सिग्नल जो है या जहां पे भी ट्रांसपोंडर होगा वहां से वो सिग्नल जो है वो अपलिंक होगा हमारे यहाँ पे ओटीटी में या टीवी में आर भी से डाउन पे हमारा डिवाइस है जहाँ पे हमारा सो ये केसेस में देयर वाज अ जजमेंट इन द केस ऑफ सेट सैटेलाइट, सोनी एंटरटेनमेंट का जजमेंट है, जहां पे बोला कि भाई हम तो सिर्फ सिग्नल मिलता है इधर, हमको और कुछ नहीं मिलता है, ट्रांसपोंडर किधर है हमको मालूम नहीं, वो इक्विपमेंट का वो क्या करते हैं हमको मालूम नहीं, हमको तो सिर्फ देखने को मिलता है, इधर दिखाने को मिलता है, देखने को नहीं। तो ये कैसे टैक्सेबल है इंडिया में? तो कोर्ट ने भी बोला यार बात तो बराबर है, इक्विपमेंट मेरे कंट्रोल में नहीं है, मैं उसमें कुछ छेड़खानी कर नहीं सकता, तो व्हाट आई एम गेटिंग इज ओनली राइट यूज द सिग्नल्स, नॉट इवन द इक्विपमेंट, आई डोंट हैव एनी कंट्रोल ओवर द इक्विपमेंट। अभी वो काफी यंग लोग यहाँ पे, बट पुराने लोगों को पता हुआ वो एंटीना होता था, राइट? तो अगर आपका सिग्नल खराब हो गया तो टेरेस पे जाके बारिश में खास करके एंटीना वेंटीना, अभी यहाँ पे समझो बफरिंग हो रहा है, आरसीबी का मैच चालू है और बफरिंग हो रहा है, क्या हम लोग जाके वो ट्रांसपोंडर हिला सकता है क्या? इट इज नॉट इन अवर कंट्रोल। तो दैट वाज आर्ग्यूमेंट कि भाई ये इक्विपमेंट हमारे कंट्रोल में है ही नहीं, तो फिर सोर्स इज नॉट इन इंडिया, यूज इंडिया में हो रहा है, तो इंडिया टैक्स भरेगा। सुप्रीम कोर्ट बोला नहीं, नॉट टैक्सेबल, ठीक है, हमारा ब्रह्मास्त्र निकाले, रेट्रोस्पेक्टिव अमेंडमेंट, ठीक है। सो इररिस्पेक्टिव ऑफ पोजीशन, कंट्रोल, यूज, लोकेशन, किधर भी है हमको लेना देना नहीं है। और ये वर्डिंग भी आप देखोगे ना, इट वाज ऑलवेज मेंट टू बी सो, अरे पहले से हमारे मन में पहले से था, कोर्ट को नहीं समझा, ये है एक्साइटमेंट में अमेंडमेंट लेके आए, ट्रीटी का क्या करोगे? उधर अभी भी वैसा ही है। तो यहाँ पे यू स्टिल हैव द ट्रीटी प्रोटेक्शन, एक्ट में तुमने कर लिया, ताली बजा लिया, हमने बहुत बड़ा काम किया, बट फायदा कुछ नहीं हुआ, क्योंकि वाले बिग फोर है। प्रॉब्लम बिग फोर का ये है कि उनको उस कंट्री का भी लॉ पता है और उनको भी पता है, इंडियन बिग फोर। तो द आइडिया हियर इज, तुम कितना भी अमेंडमेंट लेके आओ, आपको ट्रीटी प्रोटेक्शन है, दैट इज व्हाट वी नीड टू अंडरस्टैंड, दैट इज वेयर द ट्रीटी कम्स इनटू पिक्चर अगेन एंड अगेन फॉर रॉयल्टी, एफटीएस, परमानेंट एस्टेब्लिशमेंट, एवरीथिंग, राइट? प्रोसेस इंक्लूड्स यूज और राइट टू यूज ट्रांसमिशन, ये जो मैं एग्जांपल बोल रहा था, right, to use transmission by satellite including uplinking, amplification, conversion for downlinking of any signal, cable, optic fiber or similar technology irrespective whether such process is secret, expanded scope to cover software payments, क्योंकि ये भी एक आर्गुमेंट का, वो लोग वो कैसा करता है वो भी नहीं मालूम हमको, वो भी सीक्रेट है, तो गवर्नमेंट बोलता है सीक्रेट है, नहीं सीक्रेट हमको लेना देना नहीं, इट इज टैक्सेबल, तुम पैसा पे कर रहे हो इंडिया में टैक्स, to cover software payments, bandwidth charges, transponder hire charges, ये इंडस्ट्री, राइट? तो अगेन टैक्सेबिलिटी किसमें होगा? रॉयल्टी का 916 में, किसमें होगा? 916। अभी कैसा है टैक्सेबिलिटी? ग्रॉस बेसिस 20% था, या अभी भी 20% ही है, एक्ट में 20, राइट? एक्ट important in royalty is why treaty comes into picture, because the definition is restricted. Now I don't have time to go deep into the definition and all, but I'm just quickly covering the concepts कि बेनिफिट ये है कि स्कोप जो है, डेफिनेशन जो है वो रिस्ट्रिक्टेड है। अभी जो हमने अपलिंकिंग डाउनलिंकिंग ये जो अमेंडमेंट डिस्कस किया वो ट्रीटी में उड़ जाएगा, वो रेलेवेंट ही नहीं है, राइट? सो देयरफॉर ट्रीटी प्लेज अ वेरी वेरी इंपॉर्टेंट रोल ऑन टैक्सेबिलिटी, क्योंकि एक एक्ट में रेट भी मेरा 20% है, ट्रीटी में रेट भी कम है, कहीं पे 15 है, कहीं पे 10, स्कोप भी रिस्ट्रिक्टेड है कि एक्ट में वो टैक्सेबल होगा पर ट्रीटी में वो टैक्सेबल नहीं होगा, राइट? सो अगेन ट्रीटी में कौन सा आर्टिकल देखना है आपको? आर्टिकल again 917 definition is given in explanation to 917. It covers managerial, technical and Again, treaty plays a vital role because in some treaties, managerial word is not. Managerial word is not. Interestingly, in some FTS clause itself is not there. For example, treaty है ही नहीं, FTS clause है ही नहीं. तो जब FTS clause ही नहीं है, तो तुम टैक्स ही नहीं कर सकता है. Yes or no? So therefore, treaty plays a very very important role in taxability of FTS also, fees for technical services also. राइट एक और कंसेप्ट है ट्रीटी में जो बोलता है मेक अवेलेबल. यूएस में, यूके में, सिंगापुर में, ऑस्ट्रेलिया में, ये सभी की ट्रीटीज में देयर इज अ कंसेप्ट ऑफ मेक अवेलेबल, विच मींस अगर आप कोई सर्विस प्रोवाइड कर रहे हो, यू शुड मेक अवेलेबल द टेक्निकल नॉलेज, एक्सपीरियंस, स्किल, नो हाउ और प्रोसेस टू द इंडियन पर्सन, ओनली देन इट विल बी टैक्सेबल. समझा कुछ? एग्जांपल है, अगर मैं सर्विस ले रहा हूं, अगर मैं यूएस से कोई सर्विस ले रहा हूं, अगली बार सर्विस चाहिए तो मैं वो खुद से, अगर ये चीज मुझे अगली बार करनी हो तो मैं क्या वो सीख के अगली बार कर सकता हूं? अगर इसका आंसर यस है, then only it makes available. If the answer is no, if I have to go back to them again, if I have to go back to them again for the next lot of service, then ये चीज अभी मैंने करवा ली समझो यूएस, बट अगली बार क्या मैं खुद से, if the answer is yes, only then it technically makes available. Otherwise, I do not technically make available. Most of the cases you cannot do it again on your own. So when you cannot do it on your own, it does not make available the technical knowledge. Just in a layman's say that this is not, if it does not make available, right? So देखो लिस्ट है यहाँ पे, यूएस, यूके, सिंगापुर, ऑस्ट्रेलिया, कनाडा का कंसेप्ट. अगेन जनरली रॉयल्टी एंड एफटीएस का आर्टिकल एक ही होता है, किसी किसी कंट्री में 12-13. Otherwise, both royalty and FTS fall under Article 12 of the respective tax treaties. The case may be. Dividend interest का अगर dividend again 20%, interest on infrastructure bonds 5%, 5% rupee denominated bonds. These are the snapshots. Few exemptions which are available for थोड़ा बहुत chocolate. Transfer by non-resident to another non-resident, specifically for DRs, that is global depository bonds or bonds. Transfer by non-resident to another non-resident of rupee denominated bonds. Transfer by non-resident of rupee denominated bond or derivative on IFSC. Transfer by non-resident to another non-resident government security covering periodic interest, right? So this is exemptions to non-resident. MFN clause, again one last concept which I'll cover before we conclude. Again this is interesting because MFN clause क्या है? Most favored nation. अभी as I said कि कुछ countries यहाँ पे देखा यूएस, यूके, सिंगापुर अवेलेबल क्लॉज है, राइट? बाकी कंट्री पर कुछ कंट्रीज में लाइक फ्रांस, स्पेन, नीदरलैंड्स, स्विट्जरलैंड, ये कंट्रीज में मोस्ट फेवर्ड नेशन क्लॉज है. मोस्ट फेवर्ड नेशन क्लॉज क्या बोलता है? क्या ने मेरे साथ ट्रीटी है, अगर मैं फ्रांस का एग्जाम, गुड, इधर गया, ये रहा, देखो ये एग्जांपल देख लो. If I have entered into a treaty with Netherlands, if I have entered into a treaty with Netherlands, नीदरलैंड के साथ ट्रीटी के बाद इंडिया कोई ऐसा ट्रीटी तो वो स्कोप कम कर देता है. अभी स्कोप में देखा क्या अवेलेबल क्लॉज है, स्कोप रिस्ट्रिक्ट करता है. या तो रॉयल्टी में कोई स्कोप रिस्ट्रिक्शन कर दिया. So one angle is restriction of scope, either by virtue of make available, किसी और 10% लाया तो वो 10% मुझे भी एप्लीकेबल होगा. If that other country is an OECD country, then idea is to have a level playing field with all OECD countries. That was the idea to bring in the concept of MFN clause. ठीक है, तो अभी बोला किसी एक कंट्री में, किसी एक कंट्री डिविडेंड का टैक्स रेट है 5%. कितना? 5%. और वो ट्रीटी एंटर हुई है नीदरलैंड के बाद, फ्रांस के बाद. ठीक है, ऐसी 3 कंट्रीज. वो ओईसीडी मेंबर है और उसका डिविडेंड का टैक्स रेट है 5%. तो किसी, आई होप और आई विश कि ऐसा ही कुछ हुआ होगा, किसी बिग फोर वाले को पार्टनर के दिमाग में आया ये एक आइडिया है, एमएफएन क्लॉज हम यूज कर सकते हैं, 5% डिविडेंड कर सकते हैं. ठीक है, तो उन्होंने सजेस्ट किया, देखा नेस्ले इज कमिंग फ्रॉम फ्रांस, तो नेस्ले को सजेस्ट किया बॉस ये देखो 5% का तुमको हम फायदा दिला सकते हैं, तुम्हारा 10% है, हम तुम्हारा 5% बचा सकते हैं डिविडेंड पे. खाली बचाने के लिए वो लोग ने whatever technique go deep into that. ठीक है, मैटर गया दिल्ली हाई कोर्ट तक. दिल्ली हाई कोर्ट ने बोला नहीं नहीं ये तो गलत है, एमएफएन क्लॉज मिलेगा. सो देयरफॉर तुम्हारा कंडीशन सेटिस्फाई होता है, एमएफएन क्लॉज मिलेगा. तो दिल्ली हाई कोर्ट ने बोला तुमको एमएफएन क्लॉज मिलेगा 5% बेनिफिट. वो दिल्ली हाई कोर्ट जजमेंट के बाद जितने भी सब्सिडरीज है फ्रांस, ये सब नीदरलैंड वाले, सब ने 5% के लिए अप्लाई करना चालू किया और सब लोग खुश हो गए. फिर आया अल्टीमेट गेम, दैट इज सुप्रीम कोर्ट. और उस टाइम पे सुप्रीम कोर्ट इतना अच्छा था, हर एक जजमेंट प्रो गवर्नमेंट. तुम कुछ भी बोलो, सन राइजेस फ्रॉम वेस्ट, ओके सन राइजेस फ्रॉम वेस्ट. तो जजमेंट इतना क्लियर जजमेंट दिया गवर्नमेंट के फेवर में कि भैया एमएफएन क्लॉज तुम्हारा ऑटोमेटिकली अप्लाई होगा ही नहीं, इसको अलग से नोटिफाई करना पड़ेगा, इसको अलग से नोटिफाई करना पड़ेगा. ये किसने बोला? सुप्रीम कोर्ट ने. अभी तक का अंडरस्टैंडिंग क्या था? कैसा होता है ना, एमएफएन क्लॉज इज पार्ट ऑफ अ ट्रीटी. प्रोटोकॉल आता है एक ट्रीटी में. ट्रीटी में हमने देखा आर्टिकल्स होता है 1 2 3 4 ऐसे करके आर्टिकल्स. ट्रीटीज में 28 आर्टिकल. उसके एंड में प्रोटोकॉल होता है. ट्रीटी खत्म हो देखोगे उसके नीचे प्रोटोकॉल होता है. प्रोटोकॉल क्या होता है? अगर तुम तो रिस्ट्रिक्शन मुझे भी अप्लाई होगा, और उसके नीचे दोनों कंट्री का बुद्ध कंट्रीज ठीक है. गवर्नमेंट का आर्गुमेंट, अगर तुमको ये प्रोटोकॉल को इंप्लीमेंट करना है तो उसके लिए अलग से नोटिफिकेशन लगेगा. दैट इज द प्ली ऑफ द गवर्नमेंट. अभी हम बोल रहे हैं भैया प्रोटोकॉल है which is a part of the treaty which is signed by both the countries, and why do you need a separate notification? Delhi High Court agreed, yes you are right. सुप्रीम कोर्ट बोलता है नो. रिटायर हो गया. पॉइंट इज they are saying this has to be notified separately. That is what Supreme Court says, that you can ये सारे जो ताली बजा रहे थे नेस्ले के नाम पे थी साथ. मेजर इंप्लीकेशन इज नॉट फॉर डिविडेंड, मेजर इंप्लीकेशन इज फॉर रॉयल्टी, फीस फॉर टेक्निकल सर्विसेज, जहां पे मेरी ट्रीटी में वो टैक्सेबल है, पर बाय वर्च्यू ऑफ एमएफएन दिस इज नॉट टैक्सेबल. मेरी ट्रीटी का रेट स्पेन फॉर एग्जांपल इज 20%, बाय वर्च्यू ऑफ इट इज 10%. इंपैक्ट इज बिग देयर. पहले टैक्सेबल नहीं था, अभी बिकॉज ऑफ दिस सुप्रीम कोर्ट रूलिंग, सुप्रीम कोर्ट रूलिंग है 5% डिविडेंड के लिए, बट द कंसेप्ट इज एमएफएन की वजह से देखो क्या हो गया, जहां पे 10% मिल रहा था, जहां पे एमएफएन का बेनिफिट इनकम टैक्स अथॉरिटीज भी दे रहा था स्पेसिफिकली फॉर रॉयल्टी एंड फीस फॉर टेक्निकल सर्विसेज, अब वो बेनिफिट गया। अब वो बेनिफिट गया जब तक, और वो जजमेंट आने के बाद भी 2 साल हो गया अभी ऑलमोस्ट, एक ही ट्रीटी नोटिफाई हुआ है, वो है स्पेन। फ्रांस अभी तक नोटिफाई नहीं हुआ है, नीदरलैंड अभी तक नोटिफाई नहीं हुआ है। एमएफएन क्लॉज हैज बीन नोटिफाइड, दैट इज स्पेन, वो भी हुआ प्रोस्पेक्टिवली, क्योंकि वो तो रेट्रोस्पेक्टिव होगा नहीं। इंडिया तो रेट्रोस्पेक्टिव सिर्फ टैक्स करने थोड़ी करता है। सो द बॉटम लाइन इज दिस एमएफएन इज अ न्यू गेम चेंजर नाउ। जो लोग पहले बेनिफिट लेते थे सिर्फ 5% की लालच से, सबकी बैंड बज गई। ठीक है, concept of P, I don't think we have time to discuss P, but yes, this is a go on and on for hours to, जहाँ पे विथहोल्डिंग होता है, टैक्सेशन, टीएस हम डिडक्ट करते हैं, इट इज नॉट वन रेसिडेंट के लिए एनआरआई से प्रॉपर्टी परचेज किया तो टैक्स डिडक्ट होगा, राइट। So this is 195. Who is to deduct tax at source? The payer in India. The payer in India has to deduct tax at source. पेमेंट किसको कर रहे हैं? को और फॉरेन कंपनी को। नेचर ऑफ पेमेंट कुछ भी हो सकता है, इंटरेस्ट, रॉयल्टी, फीस फॉर टेक्निकल सर्विसेज। सैलरी के लिए सिर्फ 192 होगा, और डिविडेंड के लिए जो अलग से सेक्शन है वो सेक्शन में टीडीएस विथहोल्ड होगा, अदरवाइज 195 विल ट्रिगर फॉर ऑल द केसेस। ठीक है, अभी पेमेंट और क्रेडिट विच एवर इज अर्लियर, दिस इज इंपॉर्टेंट। टीडीएस डिडक्ट पेमेंट और क्रेडिट at the time of payment or credit whichever is earlier, this is what the Indian law says। पर भी एक गुगली है, ट्रीटी बेनिफिट अगर आप देना हो, ये गुगली हमने कब निकाला था? बहुत सारे केसेस में क्या होता था, भूल जाते थे इंडियन को। ये हो गया, डिपार्टमेंट ने पकड़ लिया, डिपार्टमेंट ने पकड़ लिया, नोटिस इशू किया। फिर जब ये नोटिस आया तब पता चला यार अभी तो गलती तो है, तो इस गलती को कवर कैसे करें, कुछ रास्ता निकालो। 12 रॉयल्टी एंड फीस फॉर टेक्निकल सर्विसेज, इट सेज पेड बाय एन पेड, वर्ड क्या था, पेड। तो बोला अभी ये आखिरी रास्ता एक ही बचा है, पेड वाला। अक्रूवल पे टीडीएस नहीं होगा, पेमेंट पे टीडीएस होगा। ये एक आखिरी था रास्ता जो निकाला, कब? लिटिगेशन में। अब इसको लोग एडवाइस स्टेज पे भी यूज करते हैं, नहीं नहीं तुम बिंदास मत काटो। ठीक है, तो देर आर फेवरेबल रूलिंग्स। यहाँ पे देखो, रॉयल्टी और फीस फॉर टेक्निकल सर्विस ओनली व्हेन पेड टू नॉन रेसिडेंट। देर आर प्लेथरा ऑफ जजमेंट, इसमें से 2-3 जजमेंट तो मेरे खुद के, सीमेंस मेरा खुद का जजमेंट है, राइट। सो बेसिकली देर आर प्लेथरा ऑफ जजमेंट्स वेयर इन इट सेज दैट पेमेंट बेसिस पे टीडीएस होना चाहिए। तो जस्ट इन केस अगर आपका क्लाइंट से गलती हो गया है तो कवर अप करने के लिए एडवाइस इस स्टेज पे ये, बिकॉज ये लिटिगेशन को रेस करेगा, अगर गलती हो गया है तो वहां पे आप ये डिसीजन यूज कर सकते हो, क्योंकि टीडीएस में कभी भी नहीं लेने का अपने सर पे, क्योंकि एक बार आपने पेमेंट कर दिया, नॉन रेसिडेंट अपने घर पे, वो वापस नहीं आएगा आपको रीइंबर्समेंट देने टीडीएस का लायबिलिटी आपके सर पे आएगा। सो ऑलवेज प्ले सेफ एज फार एज टीडीएस इज कंसर्न, क्योंकि वो आपका इनकम नहीं है, वो उसके इनकम से काट के आपको देना है, अनलेस यू आर क्रॉसिंग अप, राइट। सो देयरफॉर ये आपको तभी यूज करना है लिटिगेशन स्टेज पे, एडवाइजरी स्टेज पे क्लाइंट को ये सलाह देना मत, बोलना भी मत गलती से, नहीं तो वो आपको सिखाएगा, लो ना फिर, राइट। ग्रॉस, ऑलवेज ग्रॉस। हाँ, अगर मैं टीडीएस बेयर कर रहा हूं तो 110 पे, अगर सामने वाला बेयर कर रहा है तो 100 पे। क्रॉसिंग अप तभी होगा व्हेन इंडिया इज बेयरिंग द टैक्स, इफ, हाँ अगर उसको, हाँ देन आई हैव टू ग्रॉस अप. अगर वो बोलता है ग्रॉसिंग अप अरेंजमेंट मुझे 1 लाख चाहिए, तो 110 पे रखूंगा और वो उसको मैं अकॉर्डिंगली डिडक्शन क्लेम करूंगा. ठीक है. So I think that's, otherwise I have too many things to cover. 15 CS, CBA, वो सब बहुत कुछ था. But I think we have time till only 12, right? Yes, sir. Yeah, very interesting. Yeah, issue I think last to last year somebody had again this came up through litigation only. Because the question is whether there is taxability of mutual fund when I am at, what is taxable? Shares. It only says shares. It does not say units of a mutual fund. So therefore, what is taxable? अगर ट्रीटी का आप स्ट्रक्चर देखोगे कैपिटल गेन वाले का, उसमें there are specific clauses which says प्रॉपर्टी है तो टैक्स होगा, शेयर्स है तो टैक्स होगा, एक्सेट्रा एक्सेट्रा. लास्ट में अदर, एनी अदर, it will be taxable in the country of residence. It will be taxable in the country of residence. So for example, if I am a Dubai resident, if I am a Dubai resident, ठीक है, दुबई में तो टैक्स है नहीं. दुबई का ट्रीटी बोलता है it is taxable in Dubai. It is not taxable in India. Can I take this plea? The answer is yes, I can very well take this plea. Only shares is taxable in India as per the tax treaties till the time the treaty is amended. Mutual fund income, capital gain on mutual fund can be subject to treaty exemption and you can save 12.5% there clearly. It is a very good proposition. You can claim that. Everything, everything. Wording of the treaty shares. Unless there is a Supreme Court or unless there is a retrospective amendment. तब तक मजा करके लो. As far as the current law is concerned, yeah, correct. See, underlying asset is shares. I agree. But read the treaty. It says transfer of shares. Am I transferring shares? The answer is no. I am transferring units of mutual fund. Wording is very clear. There is no ambiguity whatsoever here. There is no ifs and buts. Very clear position as far as the treaty is concerned. The wording is very clear. Maybe when the treaty was signed, they may not have any mutual fund इतना बड़ा, भी इतना बड़ा. As of today, for all the tax treaties, only shares is covered. Other किसी किसी treaties में है कि other assets भी tax होगा source country में, but there are many treaties where other assets are taxed only in the case of only in the hands of the resident state and not source state. So all these provisions or benefits can be taken there. हाँ, तो टीआरसी तो वही है जो प्रेस रिलीज लाया था गवर्नमेंट ने कि भैया तुमको हम टैक्स नहीं लाएंगे. इम्पॉसिबिलिटी ऑफ परफॉर्मेंस का आर्ग्यूमेंट ले सकते हैं कि मैं तो दुबई में हूं, आई एम अ रेसिडेंट ऑफ दुबई, I want to take TRC, but I'm not able to because government यहाँ पे कंसेप्ट ही नहीं है TRC का, if at all. But today, practically speaking, मिल रहा है. हाँ, बट अभी मिल रहा है तो वी कैन नॉट टेक दैट प्ली प्रैक्टिकली. तो 10F भर दो ना, 10F तो अपलोड कर दो, वो तो आप ही को करना है. पैन नहीं है क्या? पैन है ना. सो बेसिकली सोर्स एंड रेसिडेंट. ठीक है. सोर्स मीन्स द पेयर, जहां से इनकम जनरेट होता है. इनकम एज इन income utilized होता है, that is the source. In majority of the cases, in this case shares etc. और जो भी transactions, when the payer is in India, it means the source is in India. इनकम जनरेट कहाँ पे हुआ? इंडिया में. सो इनकम जहां पे जनरेट हुआ उसको हम कहते हैं सोर्स स्टेट. रेसिडेंट स्टेट मतलब जहां जो रेसिपिएंट है वो जहां का रेसिडेंट है वो हो गया रेसिडेंट स्टेट. सो जनरली रेसिडेंट बेस्ड टैक्सेशन हर कंट्री में है. मेजर रेसिडेंट ग्लोबल इनकम इज टैक्सेबल. However, 916, 917 ये सारे डीम प्रोविजन है जहां पे इवन इफ यू what you have deemed. Sorry. No, it is allowed. I know because I who have actually invested in mutual funds. There are few mutual funds which have restricted it because of FATCA regulations. If you have, so those restrictions are by few mutual fund houses, but there are many others who are allowing. And why? Houses to
give some clarification with regard to 15CB. When an NRI is transferring his funds back to his country, the banks are insisting on calling it repatriation.
Technically not required. Practically, you will have to do what bank says.
But sir, the first website, we've
Correct.
gone back.
Because this is a pain point. This is a pain point. You go and explain them the law. It has come from the HO. Their answer is very simple. It has come from the head office. The simple point here is technically we tried everything to explain to whichever bank, HDFC Bank, ICICI Bank, Axis Bank, कितना भी बड़ा बैंक ले लो. Very straightforward. We need it. That is an obligation. That is an obligation on us. I agree. So it is for us to decide what you want to do. If all CAs come together on a platform, say we will not, then only this will change. But unity in chartered accountant is a different story altogether. Yes, sir. Yeah. 2 crores.
From outside, and that vendor.
Yes. Yes. SAP will trigger. So SAP reporting will be there.
So on import also I will have to pay TDS.
So technically no, it is just reporting SAP because you have to pay tax on the income attributable to it. So what is the income here attributable to it? Income is there is no attribution. Reporting will be there.
Sale of goods in India.
Can't
it be said that it is attributable?
Yeah, it can be argued, but again, the point is I don't have a permanent establishment in India. I don't have a presence in India. While business connection will be there, I can still try and get out of it. So reporting requirement will be there. Taxability I can still defend.
So P comes into play when there is a DTAA.
Yeah.
But when there is
no
no
P
TRC,
is there in the act also. So P is there in the act also. But yes, I agree. When there is no P, no treaty protection available, the risk is there of SCP taxation. 100% is there.
So that reporting has to be where, in what form?
So SCP reporting is there. There is a specific form. There is a specific requirement for SCP reporting.
That is annual reporting.
Yeah. No, for specific transactions where the value is more than 2 crores total during the year. Yeah, exporter. Not for it. Yeah. Ignore. There is no such agreement. I asked this question when Nobody had an answer. Assumed it is to be because there is no such agreement. The idea was initially there had to be an agreement, but practically there is no agreement in place. I got your point. Yeah. Any other questions? We can have one. Okay. Thank you. Thank you very much. God bless you.
So first of all, thank you WRC for giving opportunity to speak in front of the more than 150 people. And I know this is a difficult session after lunch, so most of the people are sleeping in time. So I will try to interact with you people so that you will awake and also learn something new. As you know, in salary there are hardly any tax difficulty as such practically if you see salary head. So out of you, how many people are salaried employee and how many are professional like partner or proprietor? So the majority wise is salaried people or professional only? So professional. So now difficulty will arise when you are making payment to your employees. So that time you need to aware ki whether you are requiring you are deducting proper TDS or not. So what I will be covering in this ki what is section 9 when the salary is taxable in India, when it is not taxable, for whom the section 10 is giving exemptions, and also DTW. We will also cover upon DTW because it happens ki some non-resident are also rendering services in India. So for that we need to refer DTW also. And the one more difficulty is ki income is taxable under salary or professional. It may happen ki you structure in such a way ki instead of salary you are giving professional fees. So that time the department questions ki whether you are making payment as a salary or as a professional fees. The practical difficulty, suppose your employee comes to you and says, sir, ab mujhe professional fees de do, I will opt for 44 ADA and 50% income dikha ke tax bhar dunga. So I will save my taxes. So in that way, many employers are cooperating with the employees. So we will see ki how to check whether it is taxable as a salary or as a professional fees. When department can take this as a professional fees and salary. And section 15, 16, 17 also we will see ki what is the meaning of salary, how to compute the salary, and what are the deductions available against salary. Then perquisites. Then we will cover the case study which are practically applying like ESOP case study, notice pay recovery, PF contribution about 7.5 lakhs now it is taxable. So what happens when you withdraw that amount from PF before 5 years? So as per section 9 of the Income Tax Act, salary is taxable when the services are rendered in India. So first condition where you are rendering the services. So as you are aware, for resident, global income is taxable. Whether you are rendering services in India or outside India, your entire income is taxable. So as such, does not matter for resident. Since global income is taxable, for non-resident it matters because the section 9 says it is taxable where the services are rendered. Service rendered means whether he is physically present, not mere the company where the employee. Suppose employee is in India, but he is rendering the services from outside India. For section 9, it is service rendered outside India, not in India, merely because the employer is in India. And the second condition, like this is the C1 is the assumption if any payment is made by the government to citizen of India, then it is deemed to accrue or rise in India, even though it is paid outside India or he is renting the services outside India. And section 10(6) of the Income Tax Act gives exemption for short period salaried employee. Suppose what happens if suppose there is foreign company and foreign company for some work, the employee comes to India for suppose 2 months period. As per section 9, the income is taxable when the services are rendered. So employee is rendering the services for these 2 months from India. So as per section 9, it is taxable, but section 10(6) give exemption. There are three conditions which he needs to fulfill, and all the conditions are cumulative. First, his stay should not be more than 90 days in India. Second, remuneration is not deductible from the employer's income in India. Third one is employer is not engaged in any business in India. So these are the three conditions he need to fulfill. Suppose the foreign company is P in India. In that case, they will be deducting this expenditure from salary, business profession. In that case, this exemption is not available. But then we will go to DTW also. DTW also provide exemption from short period rendering of services in other country. Yeah, any questions? So because you are renting the services in India, though you are renting services to third party that is outside India, but your service you are renting from India. So section 9 will be attracted because you are physically present in India. And anyway, since you will be more than 180 days in India, so anyway your global income is taxable. It won't matter from where you are rendering the services in that case. Unless you are coming for short period in India, like 2 months or more, not more than 90 days or 182 days, depends. No, sir. Recipient of the service is not relevant. No, as I mentioned, suppose the employer is in India, but suppose the Indian company has branch outside India, and for that branch you are going outside India and working for that branch. So though employer is in India, but you are renting the services from suppose Dubai branch, so it is not taxable in India as per section 9 because services are rendered in Dubai. Though employer has made payment from India, that you have to see where you are physically sitting while rendering the services. Yeah, yeah. So that's why if you see 10 section 10(6) also give exemption based on physical presence only. So this is a DTAA provision which says dependent personal services. So there are like if you see most of the article contains article 15 or sometime it is article 16 some other DTAA, but the principle remains same. What this says is salary, wages or other similar remuneration shall only be taxable in the country of resident of that individuals like employee unless the employment is exercised in other country. So let's take an example. Suppose US company is paying remuneration to US employee. So as per this section, the services are since services are rendered in USA, and section also says that this income is taxable only in the country of resident, but there are certain exceptions. So we will see the exception. What are the exceptions when the other country can also levy taxes on that salary income? So exception is that if the employment is exercised in source country, then the other country gets taxing right. So suppose the US company is making payment of salary to employee, but that employee comes to India, suppose for 5 months, hypothetically. He is sitting in India for 5 months. He is rendering services to Indian customer on behalf of US entity. So if US entity is making payment of salary to employee, so as per DTAA, see, basic rule is taxable in the country of resident only, that is USA, but it may be taxed in India if he is rendering the services from outside India, outside USA. In this case, he is rendering the services from India. So also India can have right on to tax that salary. Since services are rendered in India, but there is certain exception to that. So the exception says that salary shall not be taxable in the source country. Source country in this case is India, since US employer is making payment to Indian employee. So the source country is in India. If these are the three conditions which need to be fulfilled. First, the employee stays in source country like India, should not exceed more than 183 days in India. So in this case, suppose 5 months he was in India, then first condition is fulfilled, and these three are also cumulative condition which he needs to fulfill. Second is remuneration is paid by employer, not a resident of source country. So the company is not a resident of India. So second condition also fulfilled. Third is salary is not borne by the PE in the source country. So assuming the US company doesn't have a PE in India, so this expenditure is not claimed by any PE in India. So third condition also fulfilled. So as per DTAA, if the employee is less than 183 days in India, then income is exempt under DTAA provision. And as you are aware, to claim DTAA benefit, employee need to obtain TRC Form 10F and other documentation, which you need to give to employee. Any question in this? So as I discussed, when the income can be taxed as a salary, when income can be taxed as a professional. So there are certain criteria which you need to check whether income is salary. It should not give merely the employer has deducted TDS under 194J. It means it is a professional income. You have to see what are the condition and how the employer is controlling that employee. Whether these are in substance it is a salaried employee or it is actually a professional. So like these are the conditions which are let down in the Vocard hospital case. In that Vocard hospital, what happens? I will give you background. There was doctor who was renting the services to Vocard and full-time employee, and there was as per agreement he cannot render service to any other party. That was the condition which was there in agreement. So normally, suppose your employee is there, you won't allow him to work for any other work. That is a normally condition which you have in all the employment agreement. He cannot work for any other company and he cannot take any other work independency. So that was the condition in that. And most of the benefit which was given to the employee, that professional doctor, was similar to the which were given to the employee only. Based on that, the tribunal come to conclusion since you are only giving nomenclature as a professional fees, but he is acting as an employee only, though you are showing as a TDS under 194J. So in that case, department held the Vocard hospital as an assessee in default. They should have deducted TDS under 192 instead of 194J. under 194J, TDS rate is 10%. And if you go for salary slab rate, so it normally comes to 30% if the employee is higher bracket. So in that case, department has treated the assessee in default, and ITT held that position of the department. Hmm. So directors are allowed, I think, because if you see the role of director is other, not as a normal employee. Yeah. Professional. Yeah, they can do, yeah, they can do. Yeah, but you have to see ki they are rendering the different services for these two income. It should not happen in the same service, you are just splitting that income. So, yeah, yeah. Yeah, so you can show the two different part if the services are different for both these transactions. Like as you mentioned, ki one is as a managerial role, one is as a doctor. So you can make the two separate payment. Yeah, that is allowed. Yeah, yeah. So in this case, if you see the condition, the first condition is control and supervision, whether the employer controls that employee or not. In case of professional, if you see normally the employer does not control that professional concern. First condition is that. Second key, what are the rules which are given, which are available for the professional, whether the rules are similar to employee. If this, suppose you are giving bonus, similar leave, like 22 leaves or 30 leaves in a year, and timing is also same. So if you see that, so it is more like employee, though you are making payment as a professional. Third one is exclusivity, as mentioned, ki whether he is restricted from working for other or he can do free. If he can do free work for any other, that he is professional normally. And fourth is the nature of remuneration. Normally, ki whether you are making that, like, but the nature of remuneration does not is the sole criteria. It is one of the criteria. Like if you are making fixed payment, you can make fixed payment to professional as well as salary employee. So it is not a sole criteria, but you have to see condition all together. Ki all the facts you have to see, and based on that, you need to come to conclusion whether he is actually as a professional or he is a salaried employee. But you are showing as a professional, that you need to take care. But normally, in case of professional, if you see the PF is not applicable. Yeah, for salary. So these are, no, I'm saying, if department would come to for that. Now the income tax was looking from whether the payment is a salary or the professional fees. If suppose there are non-compliance in other law, then other law. No, no, no. That if that is linked to my salary, as I suppose I am renting two services. One is services which for fixed remuneration as a salary. So I am attending suppose board meeting and everything. That is that's a different payment. And also I am renting the services for different kind of service, like renting different services. So I can make as many as payment depend upon the services. But if that is coming from the employment agreement, then it is part of salary. So you have to see what kind of agreement is that. So that is a bonus you are saying. The bonus is part of salary. The commission is part of salary. So commission is different from what he is saying. Was one as a managing role, second one as a physician, surgeon. So if you see section 15, 16, and 17, so the salary includes allowances, perquisite, and profit leave on salary, in lieu of salary. And there are certain deductions. If you undergo under new regime, then only standard deduction is allowed. Under old regime, that you can also claim professional tax up to 2,500. For new regime, deduction is 75,000, and for old regime, 50,000. And if you see the current law and the tax rate, so most of the employee will go under new regime only, I think, unless they have use HRA or some other deductions which are not available under the new regime. But in most of the cases, I think what I have seen is people are opting for new regime because the tax rate up to 12 lakh is anyway exempt. Yeah, professional fees. No, but if yours, there is no employment agreement, suppose in yours case, there are no other compliance which you are making as an employee, but you are making as a professional. So as an employer, So you should have employment agreement instead of having going professional fees. So if you see professional, so you can highlight in the maybe audit report as if you see tax audit report, there is no such clause to report as such, unless you see you are sure it is a salary only, not as a professional fees. Okay. So you should advise the client ki you should not structure in that way just to accommodate the employee. Because what happens ki most of the transactions are done to accommodate the employee only to save their taxes as such, not the from employee angle, there is no benefit as such. Whether you make a payment as a salary or professional fees, you will get deductions. And practically people are doing that, but if you are caught, then you will go. Yeah. So what you can what you can do, you can take indemnity from employee. If any liability arises, then you will indemnify us. Maybe some. So yeah, I'm saying if there are some like search cases or something, that only department comes to know. Unless normally in the assessment they don't check whether you are making payment as a salary. But anyway, if you see the employee is making payment, but if the issue arises when he is opting for 44ADA, then in that case department is losing the revenue. In that case, one can check whether you are actually making payment as a salary and professional base. So you have to see as an employer key, you should not give all the benefits which are given to employee. I say you should differentiate between the employee and a professional when you are accommodating the employee only also. So you should have something from the what you are giving to employee. So like you can say bonus policy is not available for professional concern. You can adjust in professional fees, something like that. That you have to make arrangement. Then only this will benefit. So as per section 15, it states that any salary due from present employer or former employer, any arrears which is paid to employee also taxable, and any salary paid or allowed to him in the previous year on behalf of employer or former employer. So salary is normally taxable on accrual basis or receipt basis, whichever is earlier. So there is no option which is available to the assessee. If you see professional fees like business profession income or other sources, there option is available to the assessee whether he want to pay taxes on receipt basis or accrual basis. But under salary, the law is clear. You have to make payment on accrual basis or receipt basis, whichever is earlier. That if that event is triggered, then you have to make payment of salary, even though you have not received the salary in the same year. And so there is one exception to this. If the partnership firm is making payment to partner, so it is not taxable as salary. It is taxable as a business profit under section 40B. Due to 40B and section 28 also specifically covers that. And the explanation also says if any amount is paid as advance, it is already treated as a salary, then on subsequently it is not taxable as a salary again when he is renting the services. So these are the like breakup of the salary. What it includes: wages, annuity, any fees, commission, perquisite, profit leave or salary, any advance salary, any leave encashment, which is unless it is exempt, any PF contribution above 7.5 lakhs. And this is like Agniveer Corporation Fund introduced last time only. And like profit in lieu of salary, these are the following example where the amount is paid taxable as a salary. So if there is any payment as a termination of employment, suppose you are terminating the employment with the employer, and employer is making one-time payment, and it is taxable as a salary only. Second one is there is agreement, but you are modifying the agreement instead of cancelling. In that case, also the income is taxable as a salary. Third one is suppose you are giving joining bonus. That joining bonus is also taxable as salary. And for its key man insurance, which earlier it was the like litigative, then there is clear amendment. So any contribution to key man, that is also taxable as a salary when they are assigning the policy to you. So like so that is not like if you there I think if for that I think there is old CBD circular is there. If you are making payment which is not normally as in the course of employment, but as you mentioned as an injury, I think that is it can be treated as a capital receipt for that, because that is not for rendering the services. Yeah, so this is a case if you like normally observe ki some company have policy ki suppose there is notice period of 90 days. If you don't serve 90 days notice period, then they recover the short notice period recovery from the employee. The question arises is ki when the employer is making payment and recovering the short notice recovery, whether you can reduce that amount from your salary income or your gross salary is taxable. Suppose ki your last month salary is 3 lakh rupees and they are recovering from you 1 lakh rupees because you're not serving the full notice period. So you are only receiving 2 lakh rupees. The question is, 3 lakh is taxable or only 2 lakh is taxable? So if you see the section 16, which gives the exemptions or deductions from the employee salary, so there is no specific deductions for this, but there are some case laws which says ki only the net income should be taxable. You are not required to go to section 16, which says deductions. If the employer has made the payment net of that recovery, that only the net amount should be taxable, not the gross amount. But the litigation, what practical difficulty is, the employer on conservative basis declares the gross income in form 16. So that is the difficulty, because otherwise in form 16 the net amount is shown, so that difficulty won't arise. But difficulty arises when the employer shows the gross income and you want to show the net income. Now based on the AIS form 16 department comes, based on this you can take a view ki net amount should be taxable, gross amount, because that amount I have not received as such. And if you see that there are amendment to the contribution to PF, earlier employee can contribute any amount up to 12%, employer can contribute, it was exempt. To like there was loophole ki people were contributing more in the PF because employer contribution was exempt up to 12% earlier. So what they have come out ki total contribution up to 7.5 lakhs will be exempt, and over above 7.5 lakhs will be taxable. So this is just basic. The employee contribution is taxable as a salary, but you can claim ETC subject to overall limit if you are opting for old regime. Employer contribution up to 12% exempt, but up to overall cap of 7.5 lakhs. Over and above 7.5 lakhs, it is taxable as salary. Interest income up to 9.5 exempt. On retirement, if you complete 5 years service, then it is exempt withdrawal amount. So like for that employees contribution, if there is employer is also contributing to the PF, then interest on amount up to 2.5 lakh is exempt. And if employer is not contributing to PF, then interest up to interest on contribution up to 5 lakh is exempt. Suppose your contribution is 10 lakh rupees and the employer is also contributing 10 lakh rupees. In that case, up to 2.5 it is exempt, and on interest earned on that 7.5 lakhs will be taxable. And normally, if you see the PF department also deduct TDS on the that excess contribution. So in the that statement, they have two. One is exempt contribution. One is taxable contribution. And this is the like amendment to section 17 for the employer contribution. As I mentioned, up to 7.5 lakh it is exempt. So whatever is the amount over and above 7.5 lakhs, is that tax exempt. So when the salary is coming, suppose your salary is 50 lakhs rupees, 10 lakh is contribution from the employer, 10 lakh is the contribution from the employee. Employee contribution is taxable. So 50 plus 10 lakh, 60 lakh is your contribution, assuming the 50 lakh does not include 10. So your taxable is 60. Whatever is the contribution made by the employer, 10 lakh rupees, up to 7.5 will be exempt, and 2.5 is taxable. So your salary would be 50 plus 10 lakh plus 2.5 lakhs. And whatever is the interest under that 7.5 lakhs exceeding amounts 7.5, that also taxable. So in first year, that 2.5 is your excess contribution, that is taxable, and any interest on thereon in subsequent year also, that will be taxable. So, yes, so the intention was ki what you are doing, you are creating FD as such, you are earning and you are claiming exemption. So to plug that loophole, they come out ki up to 7.5 lakh only we will allow exemption, over and above that we will tax. So suppose your employer contribution is 10 lakh in the first year, so 7.5 is exempt, so 2.5 will be taxable in that year itself, and whatever is the interest under that 2.5 lakhs is also taxable. So suppose 2.5 lakhs is the amount, and on that suppose you earn 20,000 interest, so opening balance become 2.7 lakhs. Whatever interest under the 2.7 lakh will again taxable in next year. So that is, you assume that is your FD, which is taxable interest on that portion. That we have already covered. So like this is example which I have already given. The total contribution 9 lakh rupees, then only 7.5 lakh is exempt. So you have to see the contribution, overall contribution, not the single contribution. Suppose PF is less than 7.5 lakh, but there are other contributions, superannuation or other. Then you have to see the overall cap. 7.5 lakh is for overall limit, not for standalone basis. So in that case, 1.5 lakh will be taxable. Whatever is the accretion of that 1.5 lakh will also be taxable in the subsequent year. Yeah, first year 150 interest will be taxable, and second year 150 plus that interest. So it becomes opening balance will becomes 1,50,000 plus the interest in that year. So it may become 160. Yeah. Yeah. Yeah, that is exempt. So the practical difficulty arises. Yeah, you need to keep. Normally, if you see the PF statement also give the amount, so you can check, and there is formula key whatever is interest you earn that year, you have to divide by total amount multiply by the excess contribution. That is normally formula prescribed for computing the income. So suppose in form 16 the amount will be there, how much amount they have tax. So you have the amount wise from form 16 you can take that amount. So the difficulty arises when the employee changes the employment. So normally, if you are continuing employment for 5 years, then PF withdrawal is exempt unless some other cases like death and other are not covered. So suppose you are changing the employment after 2 years, then make sure that you transfer that PF to the same PF account number. What happens ki if the employee open a new PF now, so that is not treated as a continuation by the PF authority. So they deduct TDS on that withdrawal. So you need to make sure that when you are transferring the employment, you also transfer the PF account. Yeah, that I have covered in the case study. We will also cover. So earlier it was very simple. Now up to after 7.5 lakh taxable, 2.5 ke upar ka interest taxable. So how that will arise? We have covered the case study on that. So in this, I want to say that whenever you are transferring changing the employment, make sure you also transfer the PF and continue that PF account. Otherwise, if there are two separate PF account number, then PF authority treats this separate. Suppose you are changing employment after 3 years, and you are again opening new account number, and you after that company you leave after 4 years. So that both the withdrawal will be taxable as per the PF authority, because since in the first employment you are not contributed after 3 years, so less than 5 years. In the second employment also you only contributed for 4 years. So normally that PF authority does that practically. And we have also come across one practical situation. We have asked the question to PF authority, my employment was continuing for 5 years. They have said, you open a new account. That's why we have directed the TDS. So make sure ki you ask the employee to transfer the same PF account. It's already covered. So this is a like summary ki tax-free withdrawal when you make 5 years, like you continue for 5 years, you track the deductions exemption claim. What happens if you withdraw and if you suppose your employment is not continuing for 5 years, what happens to taxability? Whether the entire amount is taxable or only the some portion will be taxable, that we have covered in the case study. So suppose this is the example. Suppose Mr. A joined the XYZ Limited on 1st April 22. His salary is 1 crore rupees. He is opting for new regime. So he is not claiming any Chapter 60 deductions on the employee's contribution to PF. So 12 lakh is the contribution of the employer. 12 lakh is the contribution of the employee in that. So interest earned on that is 6,84,000 per year. Mr. A withdraws the fund on 1st April 25. So he's not continuing the employment for 5 years. So his income will be taxable. The question is how much amount is taxable, that we have to see. So first year when he files the return, his income salary is 1 crore rupees. Employer has contributed 12 lakh rupees. So 4.5 lakh is taxable. Then whatever is the interest above 7.5 lakhs, like on 4 lakh 50,000, assuming 20,000 is the interest, that will be taxable. And whatever is the contribution of the employee about 2 lakh 50,000, assuming 40,000 is the interest for that year, that will be taxable. So his total income will become 1 crore 5 lakh. Similar in second year and third year. So question arises when he is withdrawing the 85 lakh 68 is suppose the balance which is lying in there is PF account. The question is whether entire 85 lakh is amount taxable or some portion will be taxable. Any view on this? According to you, how much should be taxable in this case? Whether entire withdrawal should be taxable, only some portion should be taxable. Yeah, so my view also same. Up to 7.5 lakhs, over and above 7.5 lakhs, you have already paid taxes that earlier. And on that interest also you have paid taxes. So whatever is the exemption portion, like 7.5 lakhs, you claimed in 3 years, 21 lakh 50,000. So 22 lakh 50,000 plus interest, that should be only taxable, not the entire. Though PF authority deduct TDS on the entire amount, what they do, first they deduct TDS when you earn the interest, and on withdrawal also they deduct TDS. So there is, and they deduct TDS on the employee's contribution also. Normally, if employee's contribution is anyway, you have not claimed any ATC deductions under new regime. And if you have claimed, then only the amount which is claimed as a deduction is taxable, not the entire amount. But they deduct TDS on the total withdrawal, employees as well as employer contribution. So when normally what happens if you are not maintaining books of account, what we do, AIT some income le lete. But we make sure when there is some this kind of situations, you check what amount is tax already in the earlier years. Only the balance should be taxable, not the entire withdrawal. Any question? Yeah. So taxable, because he has not rendered the services for 5 years, now because the section says continuous employment, not the PF account. And I think after 3 years, the account also become inoperative, I think, as per the PF regulation. And you won't earn interest after 3 years in that case, I think. Yeah, any question? Condition for exemption is continuation of employment, not the continuation of your PF account. So like when you change the employment, when you have to also require to submit form 12B. 12B is normally you declare what is the income from the previous employer, what is the TDS they have deducted, and you submit. So then when the new employer is computing your salary and TDS, they take all the income from the earlier employer. So then there is no shortfall. What happens? You earn income of 10 lakh rupees from the previous employer, and again in the second employer you earn 10 lakh rupees. If you don't submit this data, so he will deduct TDS on only on 10 lakh rupees. So there he is also giving you slab benefit. So he will say up to 12 lakh no tax, so he will not deduct TDS. First employer deduct TDS because when you join the first employment, he has computed income assuming your salary will be 20 lakhs rupees. So he must have deducted, but your TDS would be short. So it is better to advisable to declare whatever is the correct data to the new employer. So the interest like 234C and everything will come. So there is no as such under the law, there is no penal consequences as such. Yeah. That is the only. So this is the HRA like 50 amount received, rent paid in the excess of 10%. Non-matter 40. So we will also cover case study on this. The question arises ki whether you can claim HRA along with the you are claiming deduction for your home loan. So practically it depends the facts of the case. Suppose your home, the property for which you have acquired ownership that is situated outside, say Mumbai, suppose, and you are renting the services in Mumbai, you took a property on rent, so you can claim both. But you have to check the facts of the case. Under law, there is no restriction. You cannot claim both. Under the law, you can claim both, but you have to prove it is genuine. Whatever is claimed by you, HR is genuine. And now, if you see the current ITR, also they are asking for data for HRA and that loan also from the financial institution you take loan. That the data is also asking in this current ITR. Case of Abhay Kumar Mittal of the tribunal. In this case, what happens? I will just give you background. The employee has made payment to his wife and he has claimed the HRA. The question was ki HRA is eligible or allowed under income tax or not. Under income tax, there is no restriction ki you cannot pay rent to your family member. But the thing is ki when whatever you are making payment, you should comply with all the regulation and they should be documented and look genuine. It should not look. So this, in this case, the tribunal held that under the law, there is no restriction which where the you cannot pay rent to your family member. You can pay rent to any of the family member, but that should be supported by the document and the other person has also paid the taxes on that. In this case, what happens ki wife has taken loan from husband. He has invested in the property. On subsequent sale of mutual fund, he has again repaid that loan. So tribunal said it is genuine transaction of purchase by the wife and husband can pay rent to wife. But practically it is not advisable to pay to wife in my view, because no one will think it is genuine because husband is not obliged to pay to wife as such. You can pay to relative, but it is difficult to digest ki you can pay rent to wife and claim HRA. So as per law, I said ki there is no restriction to whom you can making payment. If the other person is declaring and you can prove with the document ki it is actually I am staying in that property, actually paying rental every month based on the agreement. If suppose the payment is more than 50,000, you are also deducting TDS. Though under for HRA claim, there is no restriction ki you should deduct TDS, then only it is allowable. But now if you see in many of the cases, department is issuing notice also or message if you see message is coming you have made payment more than 50,000 for HRA claim exemptions, but you have not deducted TDS or you have not filed form 26 QB, whatever is form. So make sure that you comply with all the regulation while claiming the HRA. That's why if you see, that's why they have come out with a new regime कि ये सब हटाना है department को भी कि HRA नहीं डाले लोग. So that's why they have come out with the tax lower tax rate in the new regime. So I think after new regime, people will come to new regime even though HRA exemption is there. And the practical difficulty क्या होता है कि suppose your salary increment is January to December. So when salary increases, HRA also increases practically. So that should not be there. When your salary increase by 10%, your rent amount also increase by 10%. So it should look genuine. Whenever to whomsoever you are making payment, it should look genuine. Ki it is actually rent payment, and actually I am staying in that property. like these are the allowances, uniform allowances, traveling allowances, which are exempt under. In that, I want to capture one thing, like uniform allowances. Uniform does not mean कि आपने formal पहन लिया, that is uniform. Uniform should be dress code, like factory wages. If you see, there is dress code, or if you go to hotel, there is dress code. So the dress code is covered as per there is Supreme Court judgment of ONGC. I think there is a judgment on this. Helper doesn't allowances में वो सब नहीं आता जो आप formal attire वो सब नहीं आते. There should be specific dress code. Like suppose there is pants and shirt, which is uniform for all the employees. That is helper that uniform allowance you can claim, not for the general. There is no restriction for this. Yeah, normally uniform suppose कि आप कितना खरीदेंगे साल भर में, तो 10 बार तो 15-20 हजार रुपया, and that's why. So like for salary, like there are two components. One is actually cash payment, one is in kind or benefit given by the employer to the employees. So these are the benefits which are taxable as a salary, rent free accommodation or concessional in rent, benefit which are given to employee, or any obligation of the employee paid by the employer, or any insurance paid, ESOP, and other things. So like if you are employment with the company, and companies, there are two options. One, company can give you rent free accommodation, or company can give you HRA. There are two options available in that case. HRA we have already discussed what is exemption, and for rent free accommodation, the amount is like this is the condition. Like I think this is the old one. After revise, I think the 10% is the maximum upper cap. Earlier it was 15% of the salary. Now it is 10% is only taxable. And for the second benefit, I think most of the employer are giving is a motor car allowance to the employee. So in that case, there are two conditions in the motor car. First is who is owning the motor car, whether the employer is owning the motor car or employee. Depend upon that, the exemption is available. If the vehicle is owned by the company, then there is perquisite value, which is I think 1800 rupees plus some. If the chauffeur is also there, then 900 you have to add that. If the vehicle is owned by the employee, then the rules changes altogether. If the vehicle is owned by the employee, then the law says ki whatever amount is given to the employee minus this amount, 1800 or 2400 is only exempt. Entire amount is taxable. So in case of employer, entire amount is exempt, but only 1800 is taxable. For in case of employee owning vehicle, entire amount is taxable except 1800 rupees. And there are certain exceptions. If you are using the vehicle wholly for the business purpose or official purpose, then amount is exempt. But you have to maintain the logbook and everything. Logbook does not mean कि आप कहाँ से कहाँ गए खत्म हो गया. You have to see what was the opening kilometer, what is the closing kilometer of that month, and you have to see कि where you travel and what is the percentage of that. Suppose कि you say 80% is used for official purpose, 20% is used for personal purpose, then only 20% is taxable of the total amount reimbursed by the employer, not the 100%. But for that, you have to maintain the logbook, and that also should be approved by the employer when the logbook is maintained. So in this case, it is advisable कि employer should own the vehicle, so then there is no law where you need to maintain a document. Only the minimum amount is taxable 600 rupees or 2400. If the employee is owning the vehicle, then you have to go for all the document you have to maintain to claim the higher exemption. So now ESOP, we will come to ESOP. So ESOP are normally given to employee to instead of cash payment. So in case of startup, if any startup doesn't have cash flow, so what they do, they give the ESOP to employees to retain the employee. And normally in case of ESOP, the employee also feels I am the owner of the company, even though I am owning 0.5%, 1% of that company. They feel owner, so they give maximum output, so then their value increases, so then they will gain also in the future. So that is the intention of the ESOP. Like when the employee gives the ESOP, the employer gives the ESOP to the employee. And normally there are like taxation rules. There are three event. One is when the employer is granting the option to the employee. One is when the employee exercise that option. Third one is when the employee sells subsequently that ESOP. So what is the taxability? We will come to that taxability also. And there are some litigation also in this, how to compute that perquisite value, how to compute the holding period. What happens if you work during vesting period, sometime in India, sometime outside India, where the entire amount is taxable, only the services which you rendered in India only is taxable. And for startup, there is exemptions. Till 5 years, it is not taxable, even though you exercise that options. But there is exemption for 5 years. Till 5 years, it won't be taxable. After 5 years only, that it will be taxable. What happens in the case of startup? Suppose you have given ESOP to employees. and employee exercises in suppose fourth or fifth year, what happens ki you need to pay 30% to the income tax department on that perquisite value. The issue is there is no cash flow either in the hands of employee or in the hands of employer. So that's why they have given exemption for startup. 5 years or when the employee leaves that organizations or when the employee transfer the shares to third party. So if happening of any of the three events, this will be amount will be taxable. So for listed company, the fair value which you have to take is the market value. For unlisted company, you have to take the merchant banker valuation report. And normally this is used by the DCF method. You cannot take NAV method for this valuation. And what happens if there is foreign listed company? So whether this is a listed company or unlisted company for income tax purpose. So listed company, if you see, this is defined under section 2, which says ki shares which are listed on the stock exchange in India. So since foreign company shares are not listed in the stock exchange in India, so it will be treated as an unlisted company for income tax purpose. So like there is one landmark judgment of Biocon of Karnataka High Court judgment, which is followed and the case is pending before Supreme Court as on date. Based on that, people are claiming ESOP expenditure as an allowable deduction while filing the return. So normally ESOP expenses are amortized over the vesting period. Suppose you are giving ESOP to employee and there is vesting period. Normally vesting period can be 3 years, 5 years, depends. For suppose the vesting period is 10 years and suppose the vesting period is 5 years. So whatever is your ESOP expenses that you will amortize in 5 years, equally 5 years. So suppose 5 years is the vesting period. So 20% will come in first year. Assuming employee is continuing, there is no termination or none of the employee has left. So 20% you will amortize in each year and you will claim as a deductible expenditure. But it will be taxable in the hands of employee only when he exercises that option, not in the first year. So employer is claiming in the first year, but it is not taxable in the first year. The second event will come ki what happens when the employee exercises that options. As per section 17 rule with read with rule 3, it says ki whatever is the fair value as on date of exercise minus the whatever is the amount paid by the employee, difference should be taxable as a perquisite. And subsequently when he sells the shares, amount is taxable as a capital gain. Whatever is the value you have taken for perquisite, gross value minus the sale price is taxable as a capital gain. So let's take an example. I have also given an example in that. And when the employee exercise that options, you need to deduct TDS as per the applicable rate. Hmm. Yes. 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 Back and scroll method maybe. Yeah. So I think people are taking based on that, and I think income tax is also allowing deductions. Like if you see the income tax, there is no judgment which is on litigation. What is the fair value? They are saying either allowable or not allowable. There is no as such litigation on this amount. What you are saying, you value the option, and you add to that fair value. Also, you add that for yeah. Yeah. No, no, that is correct. I think what you are saying, option value, whatever is the option value which you are giving benefit to the, and if you see it in subsequently now, so that anyway that amount will be allowed as deductions, whether you take this, but practically what you are saying, what value of the options is to be amortized. Normally, if your company is coming at face exercise price which is similar to your FMV, then there is no such benefit. But what you are doing, you are also computing the value of the option that you are amortizing, I think. So there is no litigation as such on this principle. What the AO does directly, they say it is not allowable. So they are not going whether what is the quantum, whether this quantum is correct or not. Practically, I am not seeing any judgment where the valuation they have litigated. They are only litigating allowable, not allowable. In the court, they are referring Viacom judgment and they are stand allowing. They are also not going and because the department is not taking any argument for that valuation as such. Yes, so that yes, so that is I think correct approach as per the accounting standard. People are in, and I think India also requires that you value based on black and scroll method, and amortize that. So that should be allowed based on the Biocon, because under Biocon that was not the challenge, because earlier that account standard was not there. Now that India's and everything is there, and there is no litigation as such, because if suppose there is Supreme Court case is pending before Supreme Court, if Supreme Court affirms, then I'm in my experience also, I'm not seeing the department is challenging the valuation. They are only disallowing based on the it is notional in nature or contingent in nature. They are, and ITT is allowing based on the Biocon judgment. They are also not going how should be the amortization should be the what is the value for amortization period is there 5 years or 10 years, but on what value you have to amortize. Yeah, Karnataka Supreme Court is this is pending before Supreme Court has on it. Earlier it was a special bench decision of Bangalore Tribunal, but that is old judgment. I think this is of 4, 5, 5, 6 year. That time that was to assessment year 5, 6. Yeah, yeah. So let's take an example. ABC Limited comes with the 10,000 options. Like there are 100 employees, 100 options per employee. FMV as on date of grant, assuming ki India is not applicable. This is the simple example we are taking for understanding purpose. FMV is 110, excess price is 100, so 10 rupees, sorry. Vesting period is 5 years, and 20% will vest at the end of the each year as per the ESOP did. And exercise period is 3 years. So employee can exercise that options after 5th year, like 6th, 7th, or 8th year. If he doesn't accept exercise till 8th year, then it will lapse automatically. And assuming the FMV, when he's exercising that time, the value is 310 rupees. So if you see basic, as we understood, key 110 minus 100 is the value which is benefit allowed to the employee, but employer. But if you see in the case of in the hands of employee, the amount taxable would be 310 minus 10. So 300 rupees. What about the difference? You have taxed the employee 300 rupees, 310 basis, but deduction is claimed by the employer is only 110 rupees. So what about 200? That we will also cover. That is also covered by Biocon. So what happens to this? So total ESOP expenses for the company will be 10 lakh rupees. That 10 lakh options were there, multiplied by 100 rupees is the benefit which is given to employee. Employer will claim 2 lakh rupees per year as a deductions till 5th year. Suppose the employee exercises in 6th year. So we will tax 310 minus 10 rupees per share into 100 share for employee. So 30,000 will be taxable in the hands of per employee in the employee. So 310 exercise, date of exercise rule says. Yeah. No, Paku's value you have to check when you're exercising that option, not the date of grant. So if you see rule 3, which says you have to see the value as on date of exercise. So what in this case, as mentioned, 110 was the FMV when you grant, but when the employee is exercising that time 310. So employee is paying tax on 310, but employer is getting deduction based on 110. What about 200 rupees? So this is also covered by Biocon. What the Biocon says, whatever is the amount which is taxed in the end of the employee, that amount should be allowed to the employer over the period. Like it may be first year, second year, 5th year, doesn't matter, but the amount should be same. So in this case, you have claimed deduction of 10 lakh rupees in 5th year till 5th year. You have tax in the hands of employee 30 lakh rupees, because 30,000 is the per employee multiplied by 100 employees. So you tax 30 lakhs rupees in the hands of employee. So differential 20 lakhs rupees you will claim as a deduction in your return of income, though there is no accounting entry for this 20 lakhs in your books of account. So that you need to make sure when the employee exercises the option, you need to work out what is the expenditure which we have claimed, what is the perquisite which we have taxed in the hands of employee, and differential you should claim as a deductions. It can be vice versa also. If the value is higher earlier and it is lower subsequently, then you will offer as an income, though there is no P&L entry. Yes. He will get the 310 rupees cost. Yes. No, this is the sixth, single. Because now there is no employment period is left, na? Because we have given him ESOP for 5 years. Now he has completed 5 years period. Now that event has triggered key, what is the taxable value in that hands of employee? Same benefit should be allowed to the company. It doesn't matter key in which year it is allowable. And the Biocon, there is specific para on this. And one more thing you need to take care. The Biocon says key it is allowable in the year of vesting. What happens? Ki suppose you come out with a ESOP option in between the year, and you says ki after 1 year it will be vested. So based on Biocon, if you read the Biocon judgment, it says it is not allowable in the first year since the shares are not vested as on that financial year. It will be vesting in next year. So based on Biocon, you have to claim in the next year, not in the first year. Yeah, but in our case, it is sixth year because fifth year is, sixth year you will claim 20 lakhs is additional deductions. Though there is no accounting entry in the books of account for these 20 lakh rupees. So that you need to make sure when you are filing return and when you see there is exercise of option by the employee, then you have to compute, you have to do this exercise. What is the amount you have claimed deductions and what you have, and in your case, what you mentioned, sir, you are taking benefit based on the option. So the same principle applies. If you have to claim higher deductions, then balance will be taxable in the hands of company. If you have claim lower deductions, then it will be taxable. You can claim deductions for the balance amount. You have taken the option value is 100 rupees. In this case, the value increased by 200 rupees. 310, 110 se ho gaya. So in that case also you can claim further 100 rupees deduction. Any question on this ESOP? Normally, what happens is ESOP reserve transfer to share premium account in that case. In the exercise. Yeah, share capital account. Yeah, PNL account. Reserve, yeah. So first year like 20 lakhs rupees will be the PNL, in this case. So 10 lakh was the amount. 2 lakh is debited to PNL account in the first year. It will be ESOP reserve account 2 lakh rupees. Similar second year also 2 lakh. So your total balance will be 10 lakh in the ESOP reserve. So when the employee exercise that option, you will transfer the 10 lakh to your share premium as well as your share capital account. Whatever 10 rupees you are receiving from the employee, that will be share capital, and 10 lakh is transferred from share the share that employee reserve account debit to share security premium account. So for that 20 lakh rupees, there is no accounting entry. That I am focusing that you should claim 20 lakhs as deductions, even though there is no accounting entry for that. And income tax doesn't say if there is any entry, then only you can allow claim the deductions. Income tax is based on real income theory, and the Bicon specifically says whatever the amount is a tax in the hands of employee, you can claim deductions. 20 lakhs rupees. Yeah, in 6th year you can claim, though there is no accounting entry as such. Yeah, it will not reflect in penal account. So you have to claim when you are computing the business income. So you will start with the net profit. You will claim as other deductions. Any question on ESOP? And like employee subsequently shares that for 510 rupees. 310 is his cost and 510 is selling price. So 200 rupees is per share his gain. So multiply by 1000 shares. So and his tax rate will be 12.5%. Based on the when you are granted the ESOP, when you exercise the ESOP. Exercise, yeah. So like there are two contradictory view on this. What happens? This is like everyone is aware of Flipkart case. There were employees of the Flipkart. Flipkart has given the ESOP to employees, and in between, what happens? Flipkart has disinvested one of the investment to other company. So suppose employees, I am in the employee. I will say if you would have continued that that company, so my value would have been higher. So what Flipkart has done, voluntarily they have made payment for the diminution in the value. So they have paid suppose 40 rupees I think per share, 43 rupees per option. Question was that whether 43 is taxable in the hands of employee or it is a capital receipt not chargeable tax, because employees not exercise that option. If you use 17.2, it says when you exercise the option, that only is taxable. So in this case, the assessee has taken an argument since I have not exercised that option, so it is not taxable to chargeable tax, and there is no agreement which oblige the Flipkart to pay. So they have made the voluntary payment to return the employee as such, because his value is reducing. So like there are two judgment. One is of Delhi High Court. Delhi High Court says it is not taxable in the employee because the employee has not exercised the option. And if you see section 17, read with rule 3, there is mechanism how to compute the perquisite value, which says FMB as on date of exercise minus the amount paid by the employee. So they says this is not fulfilled, so it is not taxable under section 17.2. So this is the judgment of Delhi High Court, and on the same identical facts, there was one more judgment of Madras High Court. This is another employee. One was in Delhi, one was in Madras. And in Madras High Court held it is taxable as because if you say section 17.2, which say directly or indirectly words. So it says even though the mechanism is not there to how to compute, but since the employer has made payment and employee is continuing with the balance ESOP, so it is taxable as a salary. So there are two contradictory judgment on the same identical facts. So they say they are like High Court is saying it is profit in lieu of salary, since the section 72 is much wider to cover this. So if you see they are saying value of any specified securities that is covered under section 72. So they are saying it is very wide to cover the payment made by the Flipkart to the employees. So in this case, they have held that it is taxable as a perquisite. So like these are the practical difficulty which arise when you are receiving the ESOP from the employee. Suppose ki during the vesting period, you some part you worked in India. Suppose ki vesting period is 5 years. You worked in India for 5 years, then you become non-resident in 6th year. Then you exercise that ESOP. The question is ki the amount is taxable or non-taxable in that case. Any view on this? Like we are covering the first case, then we will go to second also. So he has worked in India for during vesting period, then he becomes non-resident. And when he's non-resident, he's exercising that option. The question is for non-resident, that income is taxable or non-taxable? Yeah, so for first one, there is direct judgment of Unnai Krishnan of the Mumbai Tribunal, which says that since during vesting period, employee has given the services in India, so that amount is taxable in India, even though he is non-resident when he exercised that option. Second one was he assess he has during vesting period he worked outside India, then subsequently he comes to India and he exercises that options. So it is a reverse case of first one. Based on the first decision, the same principle would apply. When he has rendered the services, he was non-resident, so income is not taxable for that year. So since the entire vesting period he was outside India, so nothing is taxable in India. If suppose there is pro rata, suppose he worked for 3 years outside India, he worked for 2 years in India, then only 2 years is income ESOP is taxable, not entire whole period. That is there is a direct judgment of Anil Bansali, similar way. He was outside India for 3 years, he is in India for 2 years. The question is entire ESOP value is taxable on the pro rata. The tribunal held that it is only pro rata is value taxable, like whatever is the services he rendered in India, not the entire ESOP value. Like in India, like fourth one is the when you are selling the right in the ESOP. Like I think in India it is very practically not happening that. There is some sale of ESOP rights. The question is what is the nature of income? Because your employer is not giving any amount to you. You are selling that rights to third party. So normally I think there is one old judgment which says income should be taxable as a capital gain because you have right in the ESOP. Since employer has not made the payment, so section 70 is not attracted. You have sold that right to third party, and the right in the ESOP is a capital assets. If you see the definition of section 214, capital assets is very wider to include any right in the any assets. So in that judgment, they have held it is taxable as a capital gain. And the question was, what is the holding period? In that case, they have held that date of vesting is your date of purchase of that, because on date of vesting, you have a right of that ESOP. So that is your purchase date. I think in India that is not because employer is not allowing. I think in practical in India, it's earlier there was options where there so some people have done. So question was what is the nature of that income, whether it is a salary income or it is a capital gain income. So I think High Court decision they held that since I don't have any that till that date I have not exercised that option and payment is not made by the employer. So section 72 is not attracted. Yeah, I think there one judgment I will share with you. And one is the last one is if you are giving ESOP to consultant and under which it is taxable, whether as a salary or professional, so it should be taxable as a professional only. If you are giving ESOP to your consultant who are on professional basis. Okay. Hmm. Payable to holding company. But when he exercising that time, that will be payable. But only exercise price, not the entire amount, no? Yes, holding company. Yeah, so if you see that parent company is giving ESOP on behalf of Indian company only. Because what happens ki if you are giving ESOP to Indian company and Indian company is held by subsidiary holding company in outside India, so there is no value of independent subsidiary company. So practically, if you see there is holding parent, then ESOP are granted always of parent company only. In that case, what happens ki when the employee exercise, I think the subsidiary make the payment to holding company practically, because the under transfer pricing also they are required to recover the amount from the Indian company. So similar principle apply. What happens ki instead of giving your shares, you are giving shares of your parent company, but the taxation will remain same. Yeah, same. And in that you also required to report in your foreign assets disclosure also. When you are receiving the ESOP of foreign company, then you need to disclose in your FA schedule also. That you need to make sure. And whatever is the income on their own, because in my experience I have seen many cases where the same identical facts about their shares are given of the parent company outside India. So though it is taxed as a salary in form 16, but they fail to report in their ITR, because they are earlier people were not aware how to disclose this and those. So they are taking form 16, they have disclosed the transaction as an income they have offered, but they are not disclosed the transaction in their ITR. So uh, no, no, no. First year you only have a right. You have not. You don't have any assets, na. Suppose after 3 years you left the organizations, you don't have exercise period. Once you complete 5 years of vesting period and you exercise, then only you have shares. Yeah, practically people are giving. No, okay. Yeah, they are giving for professional. If you are suppose professional only that case. Yeah, so normally, but similar to ESOP, they can also be given to. I have seen practically they are giving ESOP also to professional also. Yeah, you can I think practically. Yeah, but you are giving shares only in that case also. Yeah, yeah. No, no, no. In the like 20 lakh rupees, there is no accounting entry. Mhm. But under law, you are not required to pass entry to claim deductions. What I am saying, ki, in my view, I think you are not required to pass any entry when you for difference of 20 lakhs rupees. If you don't pass entry, then also you can claim deductions. That is the principle remains. Whether you pass the entry or not pass, that is not like issue. So 194J, he will deduct TDS. Same. What is the fair value when here you are giving the options to the that consultant? Same like under 17.2 that is taxable. That will be under 194. GST is litigative. I don't know how that practically is whether GST is applicable. GST department can say for you have given for rendering of services. So what example GST department can litigate ki you have received the cash, then you have again given the cash to the company. GST is the challenge in this. This we will not cover considering time. Yeah, so this is like we will cover ki when the salary you are receiving from the foreign country. As I mentioned, ki section under section 9 taxable if you are in India for more than 90 days. If you're resident and your global income is taxable, but if you're paying any taxes outside India, then you can claim foreign tax credit. So practical difficulty like this case would be where suppose you are working outside India, then you are coming to India in between. Suppose till July, August you work outside India, then after August you come to India, and assuming you are resident or ordinary resident in that year, because you went outside India just before 2 years. So you fulfill condition of 730 days also and 2 out of 10 years conditions. In this case, since you are resident, your global income is taxable. Whatever is the salary received outside India, that is taxable. And there is no DTW benefit also for this. Since you are resident of India, you cannot claim DTW benefit as such in India. You can claim DTW benefit outside in the other country, but for India, there is no DTW benefit. So this income will be taxable in India. You can claim the whatever taxes is paid outside India, you can claim as a credit in India while computing your taxable income. And for claiming foreign tax credit, you need to file Form 67, where you need to attach that withholding document. Like in India we have Form 16. I think in other country, in US, I think there is Form W2 wages, I think form similar to the Form 16. And there is one other form. You have to give proof you have paid taxes in other country, or you can also attach your ITR which you have filed in other country. That is also sufficient proof. So as you are aware, there are two sections under which you can claim the foreign tax credit. Section 90, where India is DTAA with the other country. Section 91, where there is no DTAA benefit. There is no DTAA with the other country. So suppose USA, India has DTAA. So whatever FTC you are claiming, you will claim under Section 90 only. Suppose there is one other country, Cyprus entity, there is no DTAA. So whatever is the foreign taxes you have paid in other country, you will claim under Section 91, not under 90. Yeah, so Rule 115 is there. Rule 115 says you have to take the TTBR rate of the preceding month of in which the salary accrues. Suppose salary for the month of September is there, then you have to take the preceding month rate. That is 31st October, August, sorry. So that Rule 115 is there specifically, which says when you are earning any income in foreign currency, how to convert that. So there is specific rate, like for applicant, how to you convert for salary, other sources. There is specific mechanism they have provided. So for non-resident, there is 115A. If you see the capital gain, we convert, keep purchase, for sale, similar to that. 115 is standard. You can apply for resident as well as non-resident. And foreign tax credit is allowed lower of 2. Whatever taxes you are paying payment in India or outside India, whichever is lower. Suppose outside India, you made payment at 30%. In India, your taxable salary is at 20% only. So you will claim 20% benefit. You cannot claim refund out of your foreign tax. That is the earlier there was no mechanism. Thereafter, Form 67, Rule 128 also introduced. Now the law is clear. The lower of the 2 is allowed. And in Section 90 also they have mentioned you can claim lower of the 2. You cannot claim higher amount. There should not be any refund. So normally the intention is that you pay taxes in US and you claiming refund from Indian government. That is not allowed. This is already covered. If you are in India for less than 183 days, then it is exempt if you are non-resident in that country. We have already mentioned you are required to follow Form 67. And there is Form 10E also there. Form 10E is for when suppose foreign employee is there, he is renting service outside India, then he comes to India permanently. And in foreign, like India has PF account, similar to that, they have IRA account in outside India, US and other country. So like what happens in USA, that income is taxable when you withdraw from that account, not on the accrual basis. So India में difficulty क्या आती है if you offer the income on accrual basis, but you have not paid taxes in USA in this current year. So how to claim the foreign tax credit? So there will be loss if you offer tax income in first year, but you pay taxes in other country in subsequent year. You cannot claim foreign tax credit in the current year. For that there is Form 10E where you can opt I will pay tax on the receipt basis. When the logic is that when you withdraw that amount from the foreign that account, so you will pay tax in other country. You will pay also paying taxes in India, so you can claim the benefit of taxes paid in other country on withdrawal. But that option is available only for 3 to 4 countries. I think US and Canada. They are not notified all the countries till date. One more question arises: if you are receiving salary in Indian account, but you are renting the services outside India, it may happen that suppose you have NRI account in India, and you are renting services to non-resident, and you are also sitting in outside India, merely because you have received the salary in India, it is taxable or not. If you see Section 5, it says amount accrue, arise, or received in India for non-resident. So plain reading, it seems it is taxable, but the code have held that it is not taxable merely because you receive in India. Because salary is taxable, it is on accrual basis. First, accrued, it is accrued outside India. It is not taxable. Merely receipt should not be taxable. And second key, even if it is taxable under Section 5, so you can refer to DTAA provision. DTAA is clear. Where you are renting the services, it is taxable. So under DTAA, it is not taxable on receipt basis where you receive. The DTAA where you are renting the services that you have to see, not the in which account you are receiving. Yeah, I have already covered that earlier. If you are supposed to be renting the services outside India, but you become resident in subsequent year, then you can say when I have rendered the services, I was non-resident. So that income was accrued in that year, merely it is taxable in the year of exercise under Section 17.2. The law is So on that basis, there is judgment also. Ki whatever paid you rendered outside India, that is not taxable. Whatever rendered, with the reverse case also there. Ki suppose you rendered the services in India, then you become non-resident when you exercise. You cannot say I'm non-resident, so it is not taxable. But in that, what the like judgment says, ki the salary is taxable where the service is rendered. For ESOP, you have not rendered services when you exercise, but when you have given the services, on that basis, you are eligible for ESOP. So since you have rendered the services in India when you were resident, merely because you are non-resident in exercise, it should not be non-taxable. It should be taxable in the pro rata basis. So like there was, yeah. So under section 5, it is taxable. Under section 9, it is taxable since you are in India for more than 90 days. But under DTAA, it is exempt. The DTAA says ki you should be in India for 183 days. Since in your case, you are for 4 months, it is exempt. Then it is taxable for 4 months. Yeah, so in that case, the foreign employer has to take the TAN number in India. They have to comply with all the regulations like filing of, so they are not required to file income tax return, but they are required to file TDS return in that case. Because under section 5, it is clear. Section 5 and section 9. Earlier, there was like a issue. If you see 198, it says ki whatever is the taxes deducted under chapter 17, B, you need to gross up. But there was no provision which says ki whatever is the foreign taxes deducted also you need to gross up. To plug that loophole, like there was amendment in this budget 2025 on the 4 on the bill, which says ki even the foreign taxes deducted, you need to gross up while computing the salary in India. Earlier, people were taking view, and there is judgment also, which says ki it should not be gross up for the foreign taxes. So to plug that loophole, the law is amended. So the example is suppose your salary is $10,000 and employer has made payment of 1,500 to US government. So he received only the net amount 8,500. Earlier, people were taking view ki 8,400, 500 is only taxable and 1,500 should not be gross up again. And that was the position pre-amended. Now the law is amended. Your income would be 10,000 and you can claim credit of 1,500 rupees, subject to your taxes in India. And now one more question arises: in USA, if you see that there are two taxes, one is state tax, one is federal taxes. Federal tax is similar to your income tax, and state tax is also there, which they are required to pay to state government. The question is whether you can claim credit of your state tax or you can claim credit of only foreign federal tax. Yeah, so if you see the article 2 of DTAA, which define the taxes, they only cover the federal taxes. They are not covering the state taxes. But there are judgment which says you can claim even the state taxes based on the judgment says since federal tax is covered under country with India DTAA section 90, and so they are saying 500 you will claim under section 91 because there is no DTAA for the state tax. So based on judgment, these are the 4 judgments which are in the favor of assessee, which says you can claim the state tax also as a credit while taking the foreign tax credit in India. Yeah, both can be claimed based on the judgment, even though DTAA does not cover specifically that article of DTAA. And there is like amendment in this current year, you can report the TCS also. Earlier, what was happening, if there is TCS which is collected on your suppose foreign tour or foreign remittance, then you have to claim the refund in the return of income, or you can adjust against your other liability. Suppose there is no other liability, then you have to claim the refund. So for that, the section is amended 192 2B, which says you can also report your TCS to the employer, and the employer will factor while deducting the TDS in India. Okay. Payment basis. Next year. So practically what people are doing, they are showing even though the TDS is deducted to be under 192, TDS to be deducted on payment basis. That is correct law as per the, but the practical difficulty is there when you make the payment in next year. Suppose March month payment, you are making payment in April or May month. As per law, you are required to deduct TDS in April or May month only, as per the law. But practically, and all the people are doing what they know, even though they are making payment in April. Yeah. Yeah, for the so what in that case, what employee can do now there is provision of form 71 where you can, even though TDS is reflected in subsequent year 26 years, then you can claim in current year. There is form 71. I think the form has not been notified. Earlier there was no mechanism where you can claim the subsequent year credit. In your employee's case, this income will be taxable in the first year because he has rendered the services. Income is taxable on accrued basis. Though you have deducted TDS on subsequent year based on the 192, then he can claim this income in first year and he can offer also claim the TDS credit also of that. But there will be practical difficulty because if you see CPC, what they does, they compare with your AIS, TIS. इस साल में issue नहीं आएगा, next year में issue आएगा कि there is salary in year form 16, but there is no income. Then you have to file the appeal because CPC won't rectify this issue. Any question?
Thank you, Shruti Ben. And Sanjay bhai, the dice is yours.
Good evening, members. I thank very much the WRC office bearers, dignitaries, and all the Chetan bhai and their team to provide me an opportunity to present the my topic to you about before your audience. And it's a privilege me to provide this topic because this is a very close topic of the tax audit for every chartered accountant, because this is the only area where the chartered accountant has a monopoly. Nobody else can do it other than chartered accountant. So we'll start the topic. So why this session actually, like we have to start accordingly. How many are chartered accountants are practicing right now? So it is understand what is the quantum which is doing the tax audit and everything, and how many are in a salary or in corporate where they are working and handling the taxations. So like good amount of number would practice. So it is good because in this area very limited changes happened in this session. 25. So we'll cover those changes also, and we'll cover certain clauses which is important in the tax audit reports. I hope because most of the CAs have already done tax audit, so we are covering only the important areas which is to be covered in tax audit and the certain in this budget. So this session is for tax audit is only frontier that is actually cover the knowing recent changes. We'll understand the clauses and our responsibility, improving quality of our, reducing mistakes in sites also on those key, what are the common mistakes happen in the tax audit, what during the process of the audit, show the correct reporting, since it is a tax audit is a true and correct picture of the our reports. This is not a true and fair view, it is a true and correct picture. So the slides is covered through introduction, which cover the applicability deadlines, like what is the due dates for the compliance, and overview of tax audit forms like 3CA, 3CB, 3CD, and 3C when they are used. Only refer for the guidelines. Clause by clause. Again, I have summarized the last previous year 3CD and the current year. Like certain clauses like clause 8, 10, 18, 34, and 44. Common mistakes which generally happens. More theoretical portion, but we'll try to make it more interactive while interaction with the specific topics. Case laws which I guidelines, which is just base of the tax audit, compliance rules of as an auditor, what is so we all like different limit. Just brush up those provisions because recent changes are very limited, but total 9 changes have happened in this last budget. All those changes over the period, but we will just brief out the basic understanding of business. The tax audit is applicable if this limit is in crore since in this amendment, because if transactions, cash transactions below 5% of the like cash payment and both, if it's below 5%, crores in receipts would be 75 lakhs. Below 5, it is applicable. Other it is issued notification 23/2025 in March 20. To ensure the compliance. Introduction presumptive. First slide we have covered only the limits which is applicable for the tax audit. This is the presumptive taxation where the presumptive is applicable and we can adopt for certain kind of for businessmen. In case of if their expenditure is limit will be 3 crore, so they can adopt the presumptive taxation like 8% or 6% of the profit, the turnover they can claim as an 44 under 44 ADV, and then there is no requirement for audit. If there is a exceed this income and we are not compliant, there will be tax audit applicability. 44 ADA, the professionals like doctors, 75 lakhs limit. Which are beyond 5%, then only the limit will be the 50 lakhs. So the tax, the profit will be considered as 8% or 6% or 50% in case of professionals. Anybody has any basic in case of professional, there is no cash payment, only receipt will be considered. But in case of business, cash payment for 10 crore limit, it will be only expenses, both transactions will be covered. In case only 5%. Yes, agree. It's not necessary. Not necessary. Only if you are adopting or you are going, yeah, you are not using, you are not adopting the 44 AD for the subsequent year, then you will lose the opportunity to continue the scheme for next 5 years. Under 44 AD. They can hire offer 8% or 6%. So key deadlines generally is 1 month prior to the you have to file the tax audit reports. In case of regular taxpayer, 30th September. It may change because already maybe some change, so we need to keep watch on this. There will be penalty for non-compliance, like it is a 0.5% lower under 271B if you are not complying with the provision of filing. We need to ensure we have a reasonable clause, like He can represent his case. Say the reasonable cost was overview of tax audit forms. So there's a form 3CA, form 3CB, 3CD. 3CD is a part of as a is a separate report for the non-resident foreign companies. So form 3CA is used only when there is audit in other laws, like somebody has a audit a company, in case of company is the audit happened before the due date of the filing return, before the filing of there is an audit. It is not done before due date, then you have to issue the report in form 3CB, not in 3C. Even in case of audit has to be done, the report has to be issued before the due date of the our tax audit. Form 3CB for the entity is not audited under, we have to do the audit in the Income Tax Act. So like property, show you the form just. 3CB, if it is audited, then it will be 3CA. If it is not audited under, because there is a limit in Companies Act to audit the LLP. So in that case, if the paid up capital is about 25 lakhs, or turnover is about 40, there is an audit will be used for 3CA. Then form 3CA. Because what happens, we are doing the audit. Generally, what happens, we are taking base as a audit report of the auditor who has done audit under other acts. There are those data in our audit. So the report is prepared in such a way, already audit is done. We are just extracting the information as per requirement of the Income Tax Act. So that's why the form. The standard form. Our observations. Here the certain observation and qualification. Like in case of loan advances taken in about 20,000 by account paid check or draft, it is the bank statements or other documentation they are with it was. So generally the observation is mentioned ki we have based on the test check and representation by the management, we have not found banking transaction. Observation you can make. There is no audit has been done by the. Yes. Because what happens in many times, there is a management dispute in the companies. The audit has been delayed, or certain auditor is not available, and they are not doing the audit for since so many years. So to file the tax. Royalty or technical service. This is a separate report. Financial. for TDS, TCS certificates, statutory compliance, challan, others, payment records. Guidance note is available where the document audit procedure of compliance to ensure the compliance to the the in this year around 9 which certain so part of the portion has been removed or omitted. So we'll start with well, there is a for BBC has been added, which is a presumptive taxation for payers, yeah, non-resident person to enhance the reporting, show the reporting of the just just like there's around those business under 44 ADA. Then key amendments to the form CCTMI clause 19. This is omitted. It's been removed because to AC is a list of four section has been removed from this list. So the removal of section is majorly because of because this section has been out. This has been already. That's why it's removed. Clause 21. Expenses, payments, what we do. A point added like expenditure. New expenditure of disallowance is incurred to settings initiated notified by central government, where poor law has been prescribed under which if there is any proceeding is going on and we have incurred any expenditure in this proceedings, so that expenditure will be disallowed. So this notification 38/2025 issued on 23rd April 2025, where that expenditure incurred for settled proceedings. So under CBA, any expenditure incurred for this to ensure this is very crucial in which it was introduced, which what interest amount disallowed, and we here the disclosure has been expanded, in which 2-3 more things are covered. One is total expenditure payable required to be paid. Only two entities. Two entities are covered. Which whatever expenditure amount has been required to be paid, it has to be total amount has to be disclosed, and out of which again paid up to the time given under section 15 of the MSMD Act. Under section 15 MSMD Act says here around if there is an agreement with the vendors under small and medium the due dates for them. So up to 31st March, suppose up to 31st March, the amount was due as a paid up to 31st March before the due date. Like during there also happened the due date. So in that, if they have paid only 80 lakhs, then 80 lakhs will be allowed, will be shown as a paid up to the time given under 15 of MSMD. Paid up. The word as an inadmissible payment has been done. Get also, it has been done because this allowance has been the basis of payment. Now, here, whatever expenditure has been incurred, it will be bifurcated in two ways: amount paid up to the due date, amount not paid and inadmissible. It will be disclosed as a separate. Paid. It will be reported in clause 22 only. Like no, not as during the year, full year. You have made payment up to 31st March, 80 lakh rupees only. Suppose if you have paid after due date certain amounts, 31st March, then it will be allowed. It will not be reported in 3CD here because their word used not paid up to time given under section 15 of MSMD Act and inadmissible for the previous. If it is paid, then it is admissible. If it is not paid, it is inadmissible. Correct. Within 30 up to 31st March only. Here it will not be reported because you already paid, because this section has been based on the payment basis. We are getting deduction in the year in which we are making the payment. Like we are making payment in 31st March to 31st March. So we are allowed to take deduction, and for subsequent year, clause inadmissible. Like 80 lakhs was paid before due date. But again, 10 lakhs more has been paid after due date, but before 31st March. Then 10 lakhs allowed. So here will be 10 lakhs will be allowed. Yes, yes. But both conditions, because they use word end, like it is due before due date and also inadmissible. It is already paid before 30. For that's why here only for the a different SME में जो का particular. Yes, we have to ensure that the client has maintained all the details of the vendor registration details. We can verify those. If there is no details available, we need to qualify or we have to give the observation in the report itself. Yes. Because what happened, it's a triggering the scrutiny. Because ultimately, whatever information reporting from this, they will take decision based on those, because this ultimately it is a true and correct picture of the accounts. So they are taking out the fair value, face value. So ultimately, in that way, if there is no reporting, there may be some issue. In future, you can get a scrutiny notice. But whatever information we available, we should ensure that we are checking those information. If we have information available, we should report. If it, then again it will be incorrect. Like if you don't have information, you have to report as a qualification in the report itself. In observation, you are not provided then. Here the two amounts has to be disclosed. Total amounts during the year, whatever amounts able to them, whether it is paid or not paid, we have to disclose total amount also, and we have to disclose the not paid and whenever you make the payment. Anybody is not paying, they are just making provision standard and is paying. That's why that interest has been disallowed. Will be disallowed. We have to consider whatever expenditure debited in P&L account on those expenditure only in the form 360. Inadmissible is like if it, but year next year. It was paid, it will be paid and due and payable in the subsequent year. 31st March. If it is not paid in due date, it will be eligible. If it is paid, MSMA, correct. Correct. paid within the due date are disallowable. Agree. Yes, yes. Closing balance. Hmm. Yes. Financial year. Still you are allowed. You have paid till 31st March. The last year only was mentioned. What was mentioned as a disallowable. Their disclosure has been enhanced for total amount payable during the year also. That they have disclosed. Like they have, I'm just reading the amendment. There's no concern in it. Only if it is not paid 31st March and they have not paid, not paid within the due date also and not paid on 31st March, that amount will also inadmissible. Traders are not covered. Correct. So they are not covered in this section. Maybe because that's why we need to check the registration. If there is a registration of as a MSME under MSME micro and small enterprises, then we need to report, because our responsibility to ensure if there is a valid registration, we need to report in the. That's why we need to take the information from the client of vendor along with their registration details also. So at least we'll able to identify how much amount is to be disclosed for which vendors we have to disallow those expenses. But we abide by the provision what is happened, because ultimately correct. But ultimately we as a provision we have to stick to with the provision which is required. No, we can't extra. If there is a registration certificate as a micro and small, then we need to keep as a disallowance. Anyway, this provision has been activated since last years back. If there is any write back amount, that will be treated as a normal profit and loss statement, like profit and loss income. It will be treated as an income. If the as per agreement, whatever agreement you have with the vendors, in that agreement, whatever the due date has been mentioned, you have to make the payment within that due date. If it is not mentioned, it will be covered. In 3 days, then it will be covered. If you are making after 3 days, then it will be covered after due date. No, we can't make it, because maximum limit is given as a 45 days. If there is any agreement in which there is a more than 45 days due date, then it will be considered you have to make the payment within 45 days only. Generally, condition mentioned. Not obliged, it is obliged to based on the terms conditions between the vendors, because as per income tax, if you are not paid, you have to disallow in the books of accounts. As per act, they are required to pay the interest ideally. It is under MS. Tell you it is credited in your account, case has been deducted. You are showing that will be a delay payment has been bifurcated actually. So another side, another effect under this again certain 43B was A to G. Now that has been removed. Like in that case, there was a particularly like whatever amount tax due contributions of employer were disallowed based on the payment basis. So we have now changed the section and they have removed all the sub clauses A to G and the only referred section 43B. Like under clause 22, for the current year expenditure for MSME payments has been considered. For the subsequent year, for the this year, there is a pre-existed liability under 26 here. So complete 43B section has been referred. Earlier 43BH was not covered last year, but now there is no everything, all the subsection has been covered in this. So and the word has been changed to allow. So like we can say like pre-existed liability. If we have outstanding liability on the first day of the previous year, then during the year whatever payment we have made, liability be allowed in this current. If it was not paid, again 26B में earlier 43BH was excluded. So this excluded because already we have considered current year expenditure in clause 22. So was incurred in the previous year. So it is only accepting the 43BH, all the other sub clauses have been included here. Like if we are making payment up to tax filing return, so whatever amount has been paid against those liabilities, it will be allowed under the tax return. But in case of 43, whatever payment we have paid, it will be allowed. So it is covered under clause 22. Because ये थोड़ा critical है, अगर आप थोड़ा understanding नहीं हुआ तो we can discuss. हाँ, because क्या whatever current year expenditure in class 22, here they have removed 43BH from 26B. If you just read the line, was incurred in the previous year and for clause other than H of section 43B, which is covered the MSME outstandings. So all the current year expenditure will be covered under clause 22 and here, like from pre-existed liability, if you are making any payments, that will be covered under 26A, which will allow based on the payment. Like in last 31st, make payment of last year, March. So whatever payment we made for outstanding against the March 24, it will be allowed in this section now because this is the first year. Last year this section was introduced. I have just simplified this in this way. Like under MSME reporting, the micro enterprises and 5 crores, turnover limit, 25 crores investments and annual turnover 100 crores. Reporting under class, reporting of under clause 22 would be MSME interest and total payable, which is again bifurcated into two: paid before due date of section and not paid up to time given under section 15 of MSME. And clause 26 may be required only to report under clause 26B pre-existed liability, which is allowable on paid basis, paid during the year 26A of unpaid liability of 23-24. Another two clause has been omitted, clause 28 and clause 29, which is relevant to the shares when they received any unfair are abolished in Finance Act 2023. So this section is clause 29. If assessee receive consideration for issue of shares with which exceeds fair market value, is under section 56 to 7B. This is also redundant because the under Finance Act 24, they have repealed the more update in clause 31. New drop down has been inserted in this loan deposits and transactions. So there are certain coding has been introduced. Like earlier, we are showing with account pay, check, draft. The income tax department, they are facing problem those transactions. So we have to like convince them after under the scrutiny process. So now they have just defined the codes which we can mention. Check if code B, code A, like in this way they have created new codes which will be given in income tax form itself. Payment through non-account pay check, code C, receipt to non-account pay check D, transfer of asset. What happens? Just certain payment. We are adjusting from security. Way we can consider in any other mode also as a debitor. They've list payment through in any other mode also we can mention, but generally we check we have to report only those cases where there is a payment specific code has been defined. So they have like elaborated the codes to for their understanding and for their classification purpose. Yeah. Sorry. That we have to give the disclaimer ultimately, because ultimately we don't give the disclaimer in the report. It is maintaining the fee of checks by those checks. Other they are not disclosed. That happened. A bank statement may whatever amount of entry you are showing, like whatever party you are showing. Suppose for a party you are showing where you are taken as a loan. So what you will do, the either credit to that party. You have to select those based on the account what you have selected for the reporting under 269 SST. It is only for the loan and deposit actually. If you adjusted some data or creditors in the similar fashion, you have to disclose here. They have just codified the like all the type of transactions. Then one new clause. Use for section. Is a profit, it will be considered as a to report those. So whether the associate has received any amount for buyback of shares. If yes, we need to have received against the buyback of shares and the deemed dividend. However, if you are doing audit of proprietorship, because you have to report, yeah, you have to give some disclaimer that we have audited only this entity and we have covered those transactions. Otherwise, so you can't report. Even in case when there is a chapter 6 deduction, if they have paid from the personal account, they have not recorded in the books of accounts and they have not given us as a business books of accounts. So we are generally not reporting in that. But that will be safer for well, where specific 44A BBC has been inserted in for this carrying the business of cruise ship. So this has been enhanced the reporting for non-resident. Then reporting of deductions has been removed certain sections which has been become redundant. 32 AC, 32 AD, 32 AC, 35 CCD. And limited reporting of MSME in earlier Form 3CD. Now it has been enhanced to include the total payments and the bifurcation between the timely and delayed payments. Clause 26, they have reported like in case of tax duties, they have included the all the MSME payments also in 26A part, and they've removed it from the 26B part. Share of company, where the company has been like a share has been issued without consideration. They have limited code, and we have to mention everything in any other mode. Like if somebody has given payment by JV or something, so we need to give another mode. So it was not clear to the assessing officer in which he has to classify. So accordingly, they have inserted the codes. Certain important clause in Form 3CD, other than amendments, like in during the audit, generally 44AB section में different section where we do the audit. So we need to ensure that whatever correct section has been applied, like 44A where the turnover exceeds above 1 crore in case of business, and in case of profession we have code has to be selected, and in case of 44AD the section will be considered as a 44ABD. And in case if there is a anybody is opt out from the 44AD section, and so then we have to carry out the audit in 44ABE. So we need to ensure, because the specific correct section has to be selected and quoted in the report. Yeah. Generally, F&O transactions are considered as a trading and business. It's a part of business. So if your turnover is below 1 crore rupees and you are not reporting profit of 8% or 6% of the transactions, so definitely safer side you should conduct the audit, because as a provision, if it is below 1 crore and you are not reporting and you are considered as a small businessman, then definitely you have to do the audit in that section. Even if it is 1.5 CR, you generally have turnover limit will become a 3 crores if you are not having cash transaction in those, then still will be audit will be applicable. Certain views are there, but because we need to check receipt, total receipt, but anyway we are doing the audit for a specific transaction like F&O transactions. So generally people on safer side do the audit. It's not specifically, it can be debatable, because ultimately it is a area where COVID, most of the salary person are doing the case of in our most of the clients are doing, they are getting the profit. We have to do the total of profit or loss, absolute number. Like you earned the profit 1 lakh rupees. We have to like with the turnover working based on the requirement, and accordingly we have to apply the specific provision. If there is an audit is requirement, we should do the audit. If it is not required, we can file based on that. TDS will be applicable only like generally in case of corporate entity, TDS is applicable. But in case of proprietorship concern, if you have a tax audit in the previous year, then you are required to deduct TDS in the current year. It will not be disallowed, correct? TDS is applicable on those. Because there are many other so which has been the TDS like we need to deduct. There is no provision has been implemented in that way because government wants every income has to be considered for the TDS. So automatically everybody will report those income because now AIS, TIS, and other entities are required to report the all transactions, even credit card transaction, mutual fund transactions. In fact, the property transaction which we are reported already. So most of the things, even interest on saving bank account is also coming into the AIS, TIS. So in that way, we need to require to report everything, and we have to ensure that all the income has been reported. Like while filing the return, we need to ensure that everything is covered. Because what happens? Go by the bank statement, but certain times where there are paying AIS, it is booked as an accrual basis. If include होते हैं, but prima facie while considering the turnover for this, we need to cover the net turnover excluding GST actually. No, that will not cover because you are making payment on behalf of client ultimately, or ideally it should be separate bank account should be kept for those entries where we are collecting money from the clients for the making payments. Yes, we can opt, but we need to mention in the clause 12, we need to mention whatever profit we have received are included as a 44 AD. Yeah, as a presumptive income, we included any profit, then we need to report in the tax audit report itself. A certain amount has been included in the profit as a 44 AD profit, yeah, presumptive taxation profit. 1 crore 30 lakhs is valuation report and professional fees also. He can opt, but he need to maintain the separate books of accounts for both, and we have the sufficient documents to prove that he is maintaining two business streams separately. Because in clause 12 we required to report because certain what happens in a company or in a business we put those items into the clause 12 also. If there is a loss, then we need to first check whether the turnover, what is the turnover, and whether the if it is a loss, so definitely if it is crossing either 1 CR or 3 CR, whatever amount. If we are not showing report profit of 6%, then we need to do the audit. It is crossing 3. Have a 5% cash transaction, this type of transaction. So our turnover limit will 10 crore, and we don't require audit in this case. See, we have to, because 44 AD will come into picture in that way. The audit. AD is over the 44 AD. So that's why we'll as a chartered accountant, if you are maintaining books of accounts and profit is coming at 10%, you have to report on 10%. 10% is always higher than what is minimum requirement. You can show if you are not maintaining books of accounts and anything, you're just based on the turnover. You can disclose at 6% or 8% as a profit. Another clause is nature of business of to ensure that we are provision and everything. The business of profession will change. There are certain in profession like in case of authorized person will also considered as a professional. We need to specified provision. It is accepted. Many of chartered accountants doing the same thing, because ultimately that provision itself says, okay, if you have a turnover below that particular limit, you can claim and go adopt the 44 AD or presumptive taxation scheme. Record is showing, but we in this case actually the books of accounts not maintained. If you are maintaining books of accounts and you are showing that profit more than in books of accounts, then in this case you have to show the profit. They may catch in a different way. That's why investment program. Because what happens in presumptive taxation, generally what happens in case of a small businessman or professionals, they generally don't maintain the books of accounts. So that's why keeping all the records and maintaining all the things, it is difficult to them. So that's why presumptive scheme is introduced. So if somebody is taking benefit of presumptive scheme based on the documents and was in account, that time we have to disclose from where we have evidence of those income. It's not necessary because you have not computed the actual income. Where we have in yes, it is having an investment business. Considered as an investment business. Share trading is also considered as part of the. Ideally, it is not, because we have a separate section, we have to report separately, and we also allowed certain expenditure based on actual what we have, we are maintaining. There is a certain whatever remuneration we have received from the firm and expenditure incurred for doing those duties. Expenditure we 18 depreciation to report depreciation allowable under section 32, ensuring compliance with income. While we need to ensure accounting standard 10 also, whether the capitalization is done properly. It is also required if some expenditure are P&L nature, we need to charge up to P&L. We have to disclose those, any capital expenditure charged to P&L, not charged. That we need to like the assets capitalized under accounting standard 10, and as per the books of account maintained, we have to give the details of all the assets addition during the year. So that we need to ensure all they qualify for the assets, and the assets should not be personal use and non-business use. We need to ensure if there is a like motor car has been used for the business and non-business also, we need to assign certain proportion for non-business or personal use also. That will be fair. Get the declaration from your rates can lead to disallowance. Clause 34, TDS and TCS compliance. In that case, actually, we need to report all the TDS. We need to ensure the assessee has filed all the TDS returns under which like total TDS deducted, correct rate deducted. If there is any exemption or any relief, any low TDS certificate is there, then we need to mark. A very big clause. Yeah. Correct. In this clause, actually, we report whatever deductible and paid. If there's no deductible on those amount, so we are not required to report. Correct. What happens generally, whatever we TDS return, what we have filed, we generally go by those returns because ultimately that's the basis to prepare those information. But ideally, it is correct if we should show the gross amount, out of which whatever TDS deductible on those amount, we should show that amount as a deductible, and thereafter, in case of salary percent, the case percentage will exactly match on those. Yes. But ideally, what happened? We should prepare the reconciliation. Practical, because what happens generally, if whatever we report, we also going to get from the during the scrutiny, we have to justify those reporting why we have disclosed this. So in this case, ideally, we should prepare the reconciliation to keep it ready. But whatever reports are required to be reported, we should report, which is exactly tally with our returns and everything. Next, GST expenditure breakup. So that GST expenditure breakup we have to provide based on the requirement to ensure what is the unregistered, registered. Because what happens right now, the GST portal is online. Income tax, other getting the information from other portal also. So they want to compare key. what happens? Your GST information is going to income tax return also. They are going to going in a AIS TIS reports. So they may compare and they can ask total GST payments what you have done, your input credit you have claimed, and whatever GST vendors expenses you have incurred. They may ask for the reconciliation in future, but right now the information are in piecemeal basis, so they may not be exactly, but over the period it will happen. That way they can reconcile those numbers with other information received from other portals. That's why they're taking this information. So I'll just show you that chart. The under clause 44. Yes. What happens? They want to ensure that whatever amount you are paying to unregistered dealer or others, those amount you are deducting TDS or not, whether they can just compare based on the analysis. Now. Correct. Correct. That's why reconciliation is necessary. Depreciation salary, yeah, correct. Because already what happens generally in P&L, whatever expenditure we have debited, generally we go by that those expenditure. Because what happens in future also, if some queries come, we can compare with those reconciliation. Because what happens Abhi, in online era, actually everything is our work will become only reconciliation. Because what happens, they are getting the basic information from the respective portals, but reconciliation they want from the chartered accountant to do and give them. So we need to keep all the documents with us, reconciliation, everything. Okay, what difficult that? True. This is mandatory. This we have to give the last year itself. It was there, any clause was there, but it is mandatory. 2023, I think this was introduced. So same it is following. There is no change in this clause in this year. There are certain common mistakes in tax audit. Generally, we do and we need to ensure. So inaccurate MSME payment, generally information is not the details of the MSME vendors and suppliers. To ensure all these details, whatever we are reporting, we should have a backup of those documents. That's the most important thing. We need to ensure, because over the period, what the tax audit has been reviewed by the income tax department, they always identify those mistakes. The chartered accountants are not reporting the information which is required to be reported. So that we need to ensure should have proper documents for those information which we are reporting. Certain case transaction, if we have to record, we need to ensure, because when we apply the threshold limit of 10 crore and 75 lakhs, we need to ensure that the case transaction are not above 5%. Because we need to correct reporting is more important, because accordingly provision will apply. That working paper, and we need to keep for 7 years as per our guidance note. Error in loan and this. So to like ensure that coding has been properly done. So now the coding has been introduced. Then again, if in any case your filing has become late, you are not able to file because of any specific reason, we need to keep all the relevant documents with us. Natural calamity hai, yeah, anything hai, which because of that we are not able to keep, because there are certain, the High Court, Supreme Court has allowed, if there is any cause beyond the control of the chartered accountant, they are allowed the delayed also and pay the penalty also. These are the certain case laws as per the guidance note. Validity of 44AB maybe is exclusive for chartered accountants. This is the area domain remain. Scope of business is any activity is a systematic activity used for the earning the income. So like share to ensure whether we are doing trading for regular basis. Doing trading on regular basis, it may classify as a trading. Sure. Fields already like defined under. Other some like also classified. Like company secretary, film artist, authorized representative, writer, and IT professionals. Whether clearing forwarding agent is a business, it is also considered as a business, clearing forwarding. Previous side. They have prescribed the books of accounts like for different to maintain the whatever clients they whatever service they are doing. Like in case of doctors, we require to maintain the case records. Case 44(8AA) is required. This is the correct prima facie. Yes, it is prescribed for them. Correct. I have to check actually. I think correct, but prima facie there is some provision where we can file under 44(8AA). People are filing, but there's a specific reason maybe possible. We need to identify. So I need to check actually. Correct. Whether share broking is considered as a business, there is in case past also. Ensure financial market receipts are included in. We are doing. So be considered as a. Issue. Over the period, maybe many things will come online because of the GST return. Half of the books are already prepared. Like where the also certain banks are giving like integrating our accounting category also. They have given the category. You can select those category. Over the period, you can receive the P&L from the bank statement. In many banks, they are started doing that like incorporating the blockchain, whatever like you define as a those expenditure. Role is to ensure e-filing is done properly. So for that, we need the digital signature to be registered on timely. Very critical. Do the audit properly and we can track those, verify those payments. Maintaining working papers, verify MSME payments within 45 days or 15 days, no credit limit. Cross verification from TDS, GST, contribution account structure. So there is a conclusion where we have considered the 44 BBC and the certain two clauses have been omitted, 28, 29, and certain changes has been done in 22, 26, and 31 coding has been inserted. There are so many things where sorted reports in very 15 clauses are there wherein we need to report. Other section, most of the clients, we don't have to report anything. So we need to ensure that we have the documentation of those section only, because ultimately at the end we need to face that scrutiny and other cases where we need to report all the things. Thank you, Sanjay sir. Thank you very much.
role. As said in the opening remarks, this is our privilege to have tax audit, but it comes with the pain also. So we have to understand that pain and take responsibility, and we are more responsible now. So it's like, rewards are matching or no, we have to see with the risk we take.
Over the period, what happens in our profession, we generally are not accountant. We are advisor to the clients. We are mediator for the clients and governments. Our works comes from the government, but we are giving services to the client in that way. So we have
Paid by client.
we have to balance those things. We have to report accurately also, and we have to ensure our compliance is also as per the law.
So the responsibility is on much on us actually, rather than on client. Actually, client will say, "Tum dekh lo bhai, tumko dekhne ka hai." You are paid for that. Whether it's sufficient or no, we have to decide. Thank you once again, sir. Have a loud applause for nicely explaining us all the clauses. Thank you, and thanks to all of the participants taking active part and looking. I think this topic requires full day workshop. I think
It is not a
2 hours job. Yeah, it's a full day workshop. Maybe we'll ask President sir to find out option to get a full day workshop. Yeah. Thank you, everybody. And it's the last day. At the last end, it was really
I
tough.
know it is
It's
a
tough challenge
last.
for him.
It was very tough challenge because
Tough challenge, yeah,
because
last
I got the corporate assessment. That is very important now. No, that's very important. We immediately, I think we have to work on those financials. Banana. No, that's why over the period, I think we should bifurcate our responsibility as an accountant